Good morning, everyone. We'll be starting in a few minutes. Just kind of request everybody settle down. I am Rashmika, and I will be taking over the proceedings for today. Just a few announcements before we start off. We will be having a short break around 11:45, and we will be taking questions, two from the audience here and one from our live stream as well after every session. And we'll also be sharing a digital feedback form with all of you to collect your feedback for the day today. We'd like to thank everybody for joining us in person today and also to everyone who has joined us on the live stream. We'll begin at 10:30.
Hello, this.
Investing is all about tomorrow. How we perceive the future, prepare for it, and practice our investing will determine our tomorrow. We all know this, yet it scares us so much that we wait for tomorrow instead of acting now. The whole objective of today would be to shed our inertia and prepare ourselves for a better tomorrow. With that thought, I'd like to invite our founder, Mr. Shyam, to speak about ITHOUGHT, what we want to be to you, and how together we can make a difference to your personal finance.
Good morning. Firstly, welcome to this Voices of Tomorrow event of ITHOUGHT. Personal finance is the most critical thing for every one of us. And it's something which can be done only from a buy-side perspective. It can never be done efficiently from a seller's perspective. So personal finance must always be viewed from a buyer's perspective. The genesis of ITHOUGHT itself is from this simple point. When we noticed in 2008, during that bull run, we saw that everybody was buying what was easily saleable. And what was saleable was not what was buyable. Now, this is the crux of the financial services industry. Most of the time, what is saleable, what is easy to sell, is not good to buy. And that gap is what differentiates those who make returns and those who lose money. And that's a very wide gap. Our idea was that this gap should be filled, because if it's not filled, people will not develop adequate faith in a multi-asset investment approach. In 2008, people were still mostly into fixed deposits and gold and real estate. If you look back, many of you are much younger, but those who are more experienced will understand what I'm saying. So we got into studying the financial product space to understand what is buyable. It's very easy to say what is not buyable, that we know, right? What's bad, you know. But from an investor's perspective, you have to identify what is good. When we started doing that, we found a lot of things which were very, very good, but underinvested. If I told you that an FMCG fund had 100 crores or 150 crores of assets, while an infra fund had $1 billion assets, then it was 4,000 crore plus assets, and multiple infra fund had $1 billion assets. While the one that we thought is investment worthy had 150 crore assets, then we saw the opportunity. But we still didn't think that we would translate that into a business. This was all academic. An investor looking at what other investors can do. There was no ITHOUGHT at that point in time. We also had a natural hesitation to do this work, because I have been an investor for 2 decades prior to that. And there was some hesitation, because the way products were sold, there was an entry load, and then people are paying money before investment began to intermediaries. And I didn't somehow want to be a part of that system. There was some hesitation. But the day entry load was abolished, that day I felt that, yes, this is the time to start doing something, and that's how ITHOUGHT was born. Over these 2 decades, we have been focusing on what is buyable. And we continuously look for what can be bought by investors. Because we are basically looking at it from an investor's perspective. And whatever we have done has been primarily from that point of view. This has not been easy for the simple reason that what is publicly the consensus view on best buy would typically be on our sell list. So it's like, the gap is so wide that sometimes it's difficult to bridge. The middle ground is very rare. So it's been a very interesting journey. We still learn. But the exciting thing is that we today are a manufacturer. We are also into creating multi-asset products, which include mutual funds, ETFs, stocks, global funds, everything. We are trying to create solutions which suit the investor. But through this, the DNA of ITHOUGHT is what's good for the investor. That's exactly what we look at all the time. And that's the crux of our journey in one sentence. So I'm going to tell you a few things here which are very relevant to you. What problem are we really solving? Because you have banks, you have so many boutique firms doing the same thing, and here we are trying to say that we can scale and do this for, let's say, 5,000 people and still give a very, very reliable, consistent experience, which means that we must be solving some problem, right? The first problem we are solving is that we give every investor a personal investing process. It's very, very important that the investor knows what he is going towards. Simply because you buy a product, which is a PMS, it doesn't mean that it doesn't align with what you're doing all this for. That alignment has to be there. So there should be a personal investment process. So the person who is client-facing understands the investor and aligns whatever is done for the investor according to what the investor needs. So there's a personal investment process which we give. And there is a selfish interest for me in this, because I also will need a personal investment process when I stop working. My children will need it, my family will need it, everybody will need it. So it's from that perspective that we have developed this whole thing. And a lot of my work is done by ITHOUGHT for me. Curating products that suit every investor. This is very, very important. It's very, very simple and tempting for an investor like me with experience to say that I am this investor, so I know how to do this, and therefore I will do this for you the way I do this. It doesn't work, because most investors in India have a lower risk appetite. If I said that most investors in India who invest in equity don't even have a risk appetite of a Nifty, that's the hard reality. So your beta should be lower than the Nifty. And still you should have a reasonable investment experience. So the product should actually be curated for investors with low risk appetite, help them invest, and help them invest over sustainable periods of time and give them a good investment experience. So the product curation that we have done, whether it is Solitaire or Sphere or Vriddhi or True Blue, which we are going to talk about today, is all centered around what suits most investors. And it is our judgment that investors will find what they want amongst these products, and we'd be happy to add more products if there is a genuine need for investors. So the product curation is about you, it's not about me or my personality. It's about what I think suits a lot of people. So there's a lot of putting the investor in the middle of our product curation and ideation. The third part is very, very critical. I think it's very tempting to personalize investing. It's very, very tempting because you get this larger than life image, you can write books, you can give gyan, but in the end, it doesn't solve the problem of society. It's all vanity in the end. So unless we are able to institutionalize what we do, unless we are able to make a whole lot of people think in a particular way, consistently for long periods of time, we won't be really solving a problem for society. And if we don't solve a problem for society, our existence will become questionable. So these are the three problems that we are solving. We are giving every investor an institutional and investing process which is personal. We are curating products that suit every investor, and we have institutionalized an investment philosophy. So this should do something for you, right? And that is basically removing pain points. We need to eliminate certain pain points that are very obvious. In your investment experience today, you are experiencing these pain points. The first pain point is mis-selling. Whenever I see a portfolio, I will see at least 2 or 3 products which have been wrongly purchased. No prices for guessing where they are bought from. And investors, when missold a product, don't lose just money, they lose time, they lose faith, they lose trust. Now, regaining all these 3 is going to take more time. And this last time, nobody calculates. So mis-selling is something which is a huge pain point. The second point is sporadic actions. I've seen a lot of people talk about equity when equity market is doing well. They'll be talking about something real estate when real estate is doing well. But nothing consistent, right? Suddenly everybody will talk about Adani when it is controversial. People who never went near Adani are asking last 4 days whether they can buy Adani stocks. It's shocking. But that's exactly what sporadic actions are all about. And sporadic actions always lead you to places where you should not be visiting. So that is the second pain point for investors. Impulsive decision making. This is something which I've always seen. You can't decide what to invest when you're having a nice evening with your friends. You can't do it in a party. You can't do it while you're playing golf. It sounds very exciting to think that you can do it that way, but impulsive decision making always leads to wrong decision making. That's a very big pain point for investors. The fourth pain point is being underinvested. This is something which most people see in their investing because they are not looking at the whole investment piece holistically. So somebody may have bought some stock which they really believed in, but it's very little. It doesn't move the needle of their entire financial portfolio. So the good things generally tend to be underinvested. And the corollary also is a risk, which is you buy the wrong ones more. Okay? But being underinvested in the right ones is a huge pain point. And then the misallocation among assets. Traditionally, Indians are masters at asset misallocation. And we have done it in real estate to a lot of success earlier. We have done it in gold. And the success largely has to do with the way the country is run, because the exchange rate is what is contributing to a lot of gold returns. And in recent times, in the last 1 or 2 years, I feel that people are also misallocating money to equity within equity. So you allocate the equity money, But inside equity, you're misallocating money. So that is something that I'm seeing. So these are the pain points: mis-selling, sporadic actions, impulsive decision making, being underinvested, and misallocation among assets. These are the pain points which we want to eliminate. How do we do it? We understand what you're doing. We alert you when these things happen and ensure that gradually you correct these things and avoid these things in your personal investing. There are many firms I respect in this field. There are many institutions. Some of them are here with us also. But there should be something which differentiates us. So let me tell you how I think we are differentiated. First, we are extremely research driven. ITHOUGHT is not a company which started and then went into research. We were just doing research and then we didn't know how to use the research. We had so much of fund research. And the fear was that if I put this fund research in the public domain, it would create a lot of embarrassment for a lot of people. So you can't sell the research, you can't tell about it, you can't talk about a bad fund. Even today, we are not in a position to say this fund is bad in the public domain. We would not say that. But we have a lot of research, and basically our DNA is research. So research is something where we are definitely ahead. Whether it's a mutual fund or a stock, we are always ahead. And our research strength in the organization is higher than most traditional organizations. We are very, very process focused. Why is it? Because I grew as an investor at a certain rate simply because of the process, not because of my investment ideas. The process helped me to manage my ideas better. And being process focused is the thing which every investor needs today. And that's something which we follow as a culture in our organization. This is very critical. It's not enough for us to think about how we work. It's important to make the investor work in a certain way, which is powering the right habits. 2-3 things are very simple, and I'll state them because they're very obvious. Investors have to invest consistently, regularly. That's one point. They also need to save some more money to invest in days like we saw in the recent weeks, when you have a lot of volatility and when what you want to invest is available at a valuation that is very, very desirable. When we make that into a habit for the investor reaches out and says, can I give another 3% to my portfolio? He starts thinking like that, which means that the money goes into a stock which is the best opportunity at that time. What does this do to a portfolio? Let's say you have a portfolio of 50 lakhs. You find when you have a crisis like in the recent weeks, what you want to buy falling 10% or 20%, you would be able to precisely action in those parts of the market where the returns will be much higher later when the market normalizes and when the company starts powering itself and its valuation ahead. These habits create those returns. It's not the investment genius. It's sheer power of habits. So investing consistently and also being ready to invest a little bit more when you have market events like you had in the recent weeks. This is something that we want every one of our investors to have, because that alone will create a better investment experience for the investor. Calling to action. See, in product selling, what happens is people sell and then they scoot, right? Let's say I told you to buy a fund for 10,000 rupees. The fund drops by 10%. This can happen in gold, by the way. If it can happen in gold, it can happen anywhere. The important thing is to make you invest another 20% then. Put another 2,000, right? But the general tendency of society is that I have told my client or my friend to buy this. Now it's come down. If I go and talk to him, he'll tell me it's gone down. You are responsible. We don't have that hesitation. If something is bad, we will reach out and call you again to action because it is our duty to tell you. And if you do it right, 2-3 times, you will understand the power of being called to action. In product manufacturing, there is a natural hesitation to go back to an investor and ask him to act or call him again to action when performance is bad. But calling to action when performance is bad is definitely one of the secret sauces to create better returns. So that's something which we do as a culture. And lastly, what sort of an ecosystem do we work under, right? We have a product ecosystem. We have our own products which we have manufactured. And then we also use the product ecosystem of AMCs and other companies which are going to be creating products like ETFs. But the mindset is a service mindset. So what happens is that you bring in the service efficiency in a product ecosystem. It saves a lot of time. If you create a service efficiency in a service ecosystem, it's becoming more and more transaction intensive. Whereas in a product ecosystem, we have removed that pain point completely so that we can raise the efficiency of our work. So there is a service mindset, but the ecosystem is distinctly a product ecosystem. So that is exactly what differentiates us. To sum up, we are research oriented. We want the process focus to work for every investor. We want to power habits in every investor. We will call you to action when it is the right time. And lastly, we want a service mindset to work for you in a product ecosystem. So this is what I believe differentiates us. So what do we wish to accomplish? Because we can say we are all this, but what should happen? One thing that we really want is that we want the current generation of millennials to become dollar millionaires. That's something which is aspirational for us. If I can create $10,000 millionaires, I think that is a far bigger achievement for me than whatever I achieved as an investor. Because you have to be on the journey with people for a very, very long time. It's engagement for a very long time. It's commitment. The second thing we want to do is we want people who are today in their 30s to build a wealth corpus by the time they are 50, 55. That's the second thing, right? We want them to create well-managed wealth corpus for the future. The reason is that increasingly, government is disowning that responsibility. It's not going to do it. Today, you have a compulsive need to remove your PF money when you retire. And a person cannot suddenly create a culture of managing his money better when he gets all that money in one shot. So, a well-managed wealth corpus should be something which people work towards from their 30s. That's the second one. We want robust retirement strategies for all. So most people follow very sporadic approaches to retirement strategies. We want that to be more holistic. So that is something that we want to create in the future. We are already doing it for quite a few people. And lastly, we are a manufacturer. We create products, but we want a goal product fit for every investor. We want the investor to see how the product fits with his life goals. So that is something that we want to accomplish. So these are broadly what we want to accomplish. Dollar millionaires in millennials, well-managed wealth corpus for those who are in their 30s, robust retirement strategies for all, and create a goal product fit for every customer. So this is what we wish to accomplish. Lastly, we want to raise the bar on product development as a manufacturer for the future, because we feel that the needs of society are just evolving. It's very early stage, it's very early days, and we feel that we will need to raise the bar. We will need ETF products. We will need a lot of things which are customized to solve problems of society, to create things which address sincere, serious needs of so many people. So that's essentially what we wish to accomplish. I will take questions a little later in the day, but thank you very much for being here. Today's session has been curated in a very, very interesting way. Voices of Tomorrow is going to have a number of speakers. We are going to also talk about our products in very short, pithy presentations. And post-lunch, we are having a fireside chat with PV Subramanyam in short, who has been kind enough to join us today. So stay on. It's going to be a very interesting and exciting day. I'm available for conversations with all of you. Thank you for coming, and over to Rashmika.
Thank you, sir. Thank you for walking us through the ITHOUGHT way. Just a small announcement before we proceed. Kindly request you all to turn your phones on silent or vibration to avoid any disturbances. So every investor looks forward to the budget because there's something in it for everyone. The idea of today is to bring the thought leaders of tomorrow and hear what they feel after the budget, and also to discuss the investment outlook. I'd like to invite Mr. Kalpen Parekh from DSP Mutual Fund.
Good morning, everyone. It's a very difficult topic because for last almost a decade, to be honest, I have stopped watching budgets or reading too much about it because I want life to go on and I want compounding to go on so that even I can become a dollar millionaire and not break compounding. Any event, our minds are wired to, habitually react constantly and misbehave. And all policy events, whether global or Indian, actually act as unnecessary stimulus to react, to think unnecessarily, and do something with our money and portfolio. And the biggest formula of compounding over time is time. Every time there is a new input, that formula of time gets interrupted. So, which is why I have kept only one slide on budget and actually just 3 lines. For me, and Shyam highlighted that the whole idea of these conversations is personal finance, and personal finance is more personal and less finance actually. There are only 3 key dimensions about the budget, which were takeaways for me. One was, and more for investors, more than me, for investors at large. Over the last few years, I have seen emergence of a lot of, investment ideas which are more driven around tax planning and not necessarily around the value of that idea to make it fit in your long-term perspective. So, these were market-linked debentures. So a lot of investors were putting money there, with the hope of getting returns closer to market or returns eventually closer to fixed income or bonds, but they had higher amount of tax efficiency. So money was getting invested there, and this budget has taken away the tax advantage that market-linked debentures had. So they have got equalized with fixed income instruments, and to that extent, it will have an impact in portfolios if you are holding any of them. Very recently, in the last 2-3 years, the love and affection for global investing had picked up in India. It is a great concept. Investing globally or investing in good companies anywhere in the world is a beautiful concept. But for wrong reasons, it had picked up in the last 3 years. And the reasons were mainly the last 5-7 year returns. So a lot of money had started going, between 2019, 2021. There were very few people who have been investing in these opportunities for a much longer period of time for the right reasons. And that sort of opportunity was captured through international funds. And I'll be speaking a bit about that because that was another topic that I'm supposed to talk about. But that was also exercised by investing in stocks outside through the LRS route. And on that investment route, there is a TCS now, tax collected at source of 20%, which eventually gets offset, when you file for your returns. But it is an unnecessary burden and paperwork to, first pay tax and then try to claim it back. So some break in, a smooth journey of compounding. So there are better vehicles and options to, continue with that. And the third important bucket, and I remember, during COVID times when bond yields had come down, interest rates in India were almost at their all-time low. I was, many people, many friends, many good, solid advisors nudged me to buy some of these long-term insurance products with the hope that it will give you 6% assured return and more or less tax-free return, which is similar to bond yields. But what if bond yields fall? These returns will be locked. And, there was some amount of tax benefit in these insurance policies above threshold ticket size, or rather on all investment ticket size. So I think the budget has plugged that hole also by making investments in these, making the returns of these policies on maturity taxable in line with whatever is your marginal tax rate. So logically, the point here, the way I look at it is, see, every industry will want tax benefits for its own industry. So I will want mutual funds to be tax-free. And, many times we feel happy if bank deposits are taxed or insurance products are taxed, but that's not the point. What tends to happen is we invest for tax saving first and not for the right reasons, whether the product is, suitable or fitting in our objective of being a long-term investor. So I think these are the three key important points from a personal finance and taxation point of view towards product relevance. Apart from that, the fact that not much needs to be spoken or written about the budget is itself a good point, because it's not disturbing anything in our life in terms of the economic outlook, in terms of how businesses are doing business, how profitability of companies will progress, how economy will progress. I think, in a way, the best budgets are the ones which get out of the way and let companies do their job, let professionals do their job, let investors do their job. And I think this budget achieves that. So I don't have a lot to say except the fact that life will go on this year also till something changes next year in the next year's budget. Generally, there is always this fear or worry that a budget in the last year of any government and before the next year's election can be a bit disruptive, where governments can spend a lot more, then that can put a lot of pressure on interest rates and currency and eventually stock market. Or it can be too populist. It means, again, a lot of money getting spent towards revenue expenditure, which is maintenance of day-to-day expenses, but not towards capital expenditure. So one good thing about this budget was a larger or a higher amount of allocation of government resources towards capital expenditure. And capital expenditure is about laying a foundation today, which continues to give results for long periods of time. If we are able to do capital expenditure efficiently, all capex is not good. In fact, many times, capex done by wrong people is actually bad from a stock's ROE point of view. So the same yardstick, if you apply to country's capex, as long as it is in the right hands and done in the right way with efficiency in mind, it creates opportunities in many sectors, especially manufacturing, infrastructure, industrials, engineering, so on and so forth, job creations in the future. So that was one good highlight amongst everything else. Otherwise, it was a reasonably business as usual sort of budget. So I think these are some observations I had for the budget. Apart from that, the team at iThought had asked me to talk about global diversification as an approach towards investing. And this is a new approach yet in India, because even today, I think less than 1% of India's capital gets invested globally. Now, there's no science whether it should be 1 or 2 or 10 or 50. But I'm just putting my thoughts of how do I think about investing. In fact, my way of investing is, just 2 lines. Invest in good companies. Doesn't matter which geography or country they come from. Second, don't overpay. So if it's a great company from anywhere in the world, but if you have to pay crazy prices, that investment will not make money. If it is a very cheap investment, but it is not a good quality company, irrespective of which country it comes from, it will still not make money. Then it's a value trap. So it is very simple end of the day. If we can just keep these 2 perspectives in mind and not be married to the geography. So geography actually should become irrelevant in the decision making. The larger point is investing in good companies. And typically many times one says that when you invest outside, you're diversifying. But one nuance is when you invest outside in equity stocks, you're not diversifying the equity risk. You're just diversifying the path, because the path of Indian markets could be sometimes different than the path of global companies. In the long run, all good companies will rise. In the short term, good companies of different countries may have different paths because they belong to different industries. They have different operating economics, operating model, customer segments. So there can be years when Indian tech stocks are, global tech stocks are falling and Indian bank stocks are rising. There could be years when Indian stocks overall are falling and global tech stocks are rising. So the paths can be different. But ultimately, both need to eventually rise. Otherwise, going out of India and buying something which does not rise has no meaning. So when you want to think about investing, think about, not what DSP is saying or iThought is saying at the first point. It's a very ideological question that if we were aliens and smarter aliens from another planet, how would we invest on Earth? Would we be patriotic to one country? Obviously, no, because you don't belong to that country. So you would look at few things. You would look to buy the best companies available on Earth. You would look to buy companies which are producing better returns on their capital. You would look to companies which are in different parts of the world and not just focused on one country. Just because we are in India, we look at India. If we were American citizens, we may be looking only at US, and so on and so forth. So it has to be across the globe, across the sphere, and not just cherry picking in one country where we are present. And if you see the last picture, it highlights that, a global mix of allocation towards countries, 56% is one market, which is US. And if you search for India, it is the green slice, which is 1%. So this is where how global capital is allocated. In our case, if we look at our wallets, our account statements, it would be probably 99 India and 1 elsewhere, or 100 India and 1, 0 elsewhere. So this is the broad landscape. Now, I'm not saying 56 is the right number. The number is not important. The process to decide what that number is becomes very important. Why it is important to think of investing beyond boundaries, beyond geographies also is because most points in time, we don't know. We only have illusion of our confidence that we know. But most often we don't know. Those of you who study a bit more about investing and some of the investing legends in the world outside, sorry for this very cluttered slide, but the summary of this is, this is the worst investor experiences. If investors were residing in different countries and citizens of different countries, whether in Russia, China, Germany, and then we've taken a 20-year window, because 20 years is a long enough time horizon. We always say invest for 20 years. What would have been the worst 20-year real return of a 60-40 portfolio? Why am I choosing 60-40? This study has chosen 60-40 because typically investors have that allocation of 60 in growth assets, equity, and 40 in fixed income or non-growth assets. For long periods of time, so for example, the worst return for UK was minus 46% after netting off inflation, even over a 20-year time horizon. So if you were a citizen in UK and you were investing all your money in just that country in a 60-40 ratio, if you were unlucky to invest at the peak of the bubble in those two asset classes, probably your 20-year real rate of return would also have been negative. And for someone in Russia, that number is almost 100. It was in the early 19th century. I've just given a perspective to think about that. When India had declared emergency, so those of you who are veterans or seniors would have felt that this country has no future. And this was also the time when communism was, becoming a powerful force to the democracy of the West. And China and Russia seemed to be doing everything right compared to a fragmenting, a society like India that time, because the emergency was announced and, we didn't have adequate growth rates. Actually, what happened in the next 40 years was very different. We all know where India is today, and we all know where China is. Now, the point is not trying to say India is better or Russia and China are not better. The point is to say nobody knows the future. We only can make some smart estimates about the future, and the insurance against the lack of knowledge of how the future will be is to have a broad-based asset allocation and geographical sort of investment. This is another way of representing that the best markets of the world, the best equity markets of the world are very different in every year. So if you look at 2015, China gave 9% return and India was -6. If you look at 2022, India was the best market, though the returns were less than even an overnight liquid fund. Overnight fund gave 4% return in that 1 year. India gave 2% and all other markets were negative or zero. So if you see every year, different countries have dominated the leadership. It is also a good fact that more often India has dominated the market leadership over the last 15 years, because India is becoming a more relevant market because of the quality of companies available, the quality of customer bases available, and it is benefiting the right investors. Now, I just want to give another data point. What I've said so far is more from a conceptual perspective. Now, here I'm showing some data. I've taken Nifty, which is like the growth of India, because India always has been spoken as a growth market. And then I've taken Berkshire Hathaway. I've cherry-picked, so pardon my cherry-picking here. But why have I cherry-picked is because Berkshire Hathaway is, in a way, the most versatile long-term investor with 60, 70, 80 decades of investing, using principles of sensible value investing. So I've assumed that, and you can invest, in sensible fund managers globally today, sitting here by just pressing few buttons. So over the last the first decade of this century was the decade of emerging markets, right? So Nifty gave a return, rupee return of 21%. It was spectacular return. And Berkshire Hathaway, run by Warren Buffett, whose books we have all read, and we use their quotes very easily. Those books are, lying behind our shelves always, many times not read, but they're always there. Gave a return of 5%. And then this was a time when BRICS as a terminology was coined. Brazil, Russia, India, China, and I don't know what S was. And then US was not relevant. The story was India will become the next China. I have done presentations in the last few years of that decade showing India roads and China roads, how roads of India will change and become like China. I still take 2 hours to travel from Borivali to Churchgate as I used to do that. So nothing has changed for that matter. But the stories just keep happening. Now, with those stories, the bias would have been to put all the money in these emerging countries. If I had given you the growth rates of India, China, and US in 2011 beginning, and I would have committed to you that China will grow the fastest at, let's say, 8 or 9% on their GDP. India will be number 2 at 5 or 6, not the 10% that we were, evaluating then. And US will grow the slowest. Where would we have put all our money? If we had underwritten that China will grow the fastest and US the slowest, more money would have gone to emerging markets. What happened in the next decade was Berkshire, which in a way is a proxy of the US market, went up 16.8% in rupee terms. Of course, 3-4% has come because of currency depreciation, but 16.8, and Nifty was 10.1. So, best performers keep rotating, very difficult to preempt or predict in advance. There are some thumb rules or hacks which your advisors and, thankfully, with the way Shyam has been thinking about investing for 2 to 3 decades, they've been one of the pioneers doing global investing far early and able to integrate opportunities together. Now look at the split. If I say don't be biased towards anyone, be sensible and just split between the most favorable or known market for us, which is India, and the most evolved market of the world, which is US. And if you do a 50-50 of both, the absolute return of Berkshire Hathaway is 2670, of Nifty is 3113. So mathematically, the average of these two should be somewhere around 2850. But actually, a 50-50 split, rebalanced every year, gives a return better than the individual opportunities, which is 3625. So an average of these two is higher than the individual. And this is not random. This is because the direction for both is rising, but the paths are different. There are times when India has done well, there are times when US has done well. So if you are able to rebalance, which means buy more of what has not done well, hence which will do well in the future, and vice versa, you are actually able to get a better outcome on a final return. Now, forget the final return alone. What is more important? I think a beautiful point that Shyam mentioned is that Indian investors are generally more conservative than what they behave to be, and then what they sometimes deserve to be. And it is very important because volatility is the enemy of compounding. So I'm not just looking at returns, look at volatility. And volatility is measured in terms of what can be the worst case returns over a 3-year, 5-year, 10-year period. I've taken 5 years because, assuming our time horizons are 5 years. The worst return of Berkshire was -4%. The worst return of Nifty, India, was -1.5. But an aggregate portfolio of these two had a positive return of 2.65. You would have not felt cheated or, a lack of faith that I invested for 5 years and there is no money made. Because every time when we invest, the last 1 year, 3 year, 5 year returns are very good. But the next 5 year returns could be poor. So this is one example of how blending, two sensible asset classes or geographies or companies can give you superior outcomes. Look at returns. Forget the maximum return slide because chasing maximum return is actually risky behavior at times. But if you look at median returns, 11 and 13.9 is the individual return, but the average of 2 is again higher than the individual return. So 15% is the median return when you blend both of these. So these are very important statistical data points that prove the fact that diversification makes a lot of sense. And during COVID times, my son, he's growing up. He rarely now spends time with me. So I just wanted him to spend more time with me. So I'll show a 2-minute video where I wanted just to have a random conversation with him. And this actually turned out to be an insight later on to me that when a kid can understand about good companies which are available outside India also, that can be an opportunity as well. Let me see if this works. Sorry. How can I play this video? Will you?
We are near to sleep.
You have school
it's given
tomorrow
some
then.
time.
Yeah. What time your school starts?
7:30.
But now though you are schooling from
Home.
home. So how do you start your school?
Through an app called Teams on my laptop.
Do you know Teams is made by which company?
Yeah, it's Microsoft.
It's Microsoft. And school is 6 hours.
Yeah.
But every time I come there, what I see is you're sometimes
Sometimes.
on your iPad.
Yeah.
Who makes iPad?
The company of Apple.
Well, Apple is a company, okay?
Yeah.
But what do you see on iPad?
I see videos
Yeah. And on?
YouTube.
Do you know which company owns YouTube?
Yeah, Google.
Google, yeah. Google has another company called Alphabet.
Alphabet.
Then when you're studying, what does that do?
You have your meetings.
And
WebEx app.
I do my meetings on WebEx. You know which company makes WebEx?
Cisco.
Cisco is a company. It's a US company. And in my meeting, who do I talk a lot about?
About the oldest investor, one of Warren Buffett.
Warren Buffett. You know his company's name?
Yeah, Berkshire Hathaway.
You remember the name also, no?
Yes.
Very good. And then before sleeping in the night, what do you do?
I read books on my Kindle.
Okay, it's my Kindle actually, which
Yeah, but you
I
gifted it to
gave
me.
you forever now. Okay,
Yeah.
it's now yours. You know which company makes Kindle?
Yeah, Amazon.
Amazon. And you remember a few days back, you made me buy some stupid Geronimo. And which company benefits when I use credit card?
Visa.
Visa. Yes. And all these 9 companies are in a fund in which your SIPs are happening. So I'm making you invest in the best 9 companies of the world.
Very good.
You should say thanks to me.
Thank you very much.
And how will you say thanks to me?
Thank you.
Thank you. Good night.
Good night.
Bye.
Bye.
So, the idea of this is to say that some of these companies, they are not Indian companies, but every child today knows about these because they are exposed to it. Today, if you take out your mobile and see the screen time, most of the screen time are all these global companies. So generally when companies become so deeply integrated with consumers around the world, they are catering to world market. So the profit pool for them is very large and you can take advantage of that. So that's again an advantage of global investing. And there are waves of innovation that happen around the world every few decades. And most of this innovation typically has come outside India. We can make money from the stock price appreciation. But if you also want to, participate in some of the large scale, disruptions which are happening everywhere in the world, a lot of these businesses are outside, and for example, blockchain, gene sequencing, robotics. Yesterday I was with Manipal Hospital and, they were saying that we use a product of a company called Intuitive Surgical for 95% of all robotic surgeries. And this company actually has 80% world market share. So there are so many such solid companies which have very superior operating metrics available at semiconductors, is now more prevalent in our life than plastic. Plastic was a most prevalent thing that we used to use every day, but now semiconductor has taken that place. And now, the last thing is look at how cricket transformed itself with this just one thought that when IPL happened, they said that why should all players be Indian players? Let us have a ratio of 70-30 or 60-40 and have 3 to 4 best players from outside. So again, mixing best asset classes really can create, a far more superior design. In fact, whatever I'm telling to you is not just preaching, we actually follow this. So we have created portfolio opportunities where part of our portfolio goes to the best companies of India, the right companies of India. Best is not always right, by the way. And some of the companies that I showed you in the video, this video was recorded 2 years back during COVID times. In the next 1 year, most of them fell by 20 to 30%. So just being best companies is not enough. What price you pay for them also becomes important as an investment. Now, these are some fund managers that we like, where we put our money outside, and each of them have curated their own portfolios as per their style. So like Berkshire Hathaway is dominating, he dominates in financials and consumer companies and Apple as consumer tech. But you take a fund manager like Lindsay Train, they have a lot of brands, European brands, Japanese brands, and those type of businesses. So you get a very nice mix. And that mix really helps. What is important for, again, discerning investors is look at the number towards the extreme right. The, uh, the return on equity for Indian markets is roughly between 10 to 15% at large, and the largest component is dominated by banks or lenders because they are 30% of our benchmarks. So one sector takes away large weight. The return on equity for them had gone down to single digits, now is rising. On an average over the last 5-10 years has been around 13%. Some of these global companies, when you curate them together, the ROEs are 17. So I'm not saying the later is better than the first, but you get, without compromise on core business models and operating metrics, you are able to diversify your money. So I think with that, I just want to, conclude by saying that build a portfolio with sound principles and global investing. See, today, ironically in India, there are not more than 150, 200 stocks which actually deserve our hard-earned money. And as mutual funds, we have 1,000 schemes now to invest in the same 100 or 150 stocks. So many times these stocks become more expensive than what they deserve to be. If they deserve to be worth 100 rupees, they are available at 120 or 140. Of course, there are other stocks which are, which deserve to be 100 and available at 90 and 80 also, which you try to keep in your portfolio. So when India doesn't give you choice, the world will also give you enough choice to blend portfolios and, prepare yourself for much more consistent long-term compounding. Compounding breaks if your NAV journey becomes volatile. To reduce the volatility, diversify. Diversify not just through asset allocation, but also through businesses available globally, and also businesses, the type of companies which are not available here in India. So with that, I'll just end my session, and questions I'll take later on. So we have time for 2 questions, 2 easy questions. Difficult ones for Shyam and Subra.
Yeah, so does anyone have a question?
Yes. Yeah. You take, please, can you talk on the mic?
What I meant is, see, as an investor, I buy, say, one share. I sell if I feel the valuation is higher, correct? But you cannot exit completely, right? When a SIP comes in, you still have to choose your stocks at a higher price if it is available, right? How do you do it?
No, so in fact, thankfully, mutual funds have a brilliant advantage of buying and selling, or rather selling and not worrying about tax, because every time we sell stocks in our schemes, the capital gains are tax-free in the scheme. At your level, the capital gains are different, but for us, they are tax-free. So if a SIP, every month, let's say, new 1,000 crore comes in our fund, or 200 crore comes in, our SIP book is not too large, it's 400 crores, so it doesn't worry us so much. There are enough companies at any point in time which are not very expensive for us to go and buy them. So it is not necessary that we are forced to buy just because there is a SIP inflow. We can, at any point in time when we get new money, we evaluate data points available on that day for the next 3 to 5 years, and then choose companies. So many times we continue with what we own because they are continuously, delivering as businesses, so we don't need to change them. And there are times if they've run up, we will sell that, create space, and buy what we think will run up in the next 3 to 5 years. So that is the least of our worry. And there are times when nothing in our, opportunity set is available to us at sensible prices. We don't mind saying that, don't invest right now. We shut the fund, or we actually communicate to our investors that this is the time to pause or not invest. And lastly, the levers are actually more in your control directly or through your advisor or distributors, where you can decide your asset allocation and take a call whether I want to invest more in equity or not in equity.
Hi. Hello.
Yes.
We always get confused with the long-term and short-term investment. When we buy for long-term, huge tax and all that, in short-term it starts moving up and we don't sell, and in long-term it falls less than the invested money. So how do you sort of spot?
I'm not able to understand your question.
Yeah, how do you identify long-term and short-term investments? Because what you buy for short-term will go up, but we sell and then make money, but pay a heavy tax, capital gain tax. But
So
what you
again-
buy for long-term, that when in long-term it falls less than the invested price. So how do we go about?
See, again, this
Just
tax
take
point.
an example of this Adani event, which happened in the last week. We bought it for long term, and long term, what has happened?
So again, taking just one stock as an example is not applicable to funds who are sitting here in this room, because most of us may not be even having those exposures. And one stock, experience does not define the entire market's experience, number one. Number two, like I answered, for us, taxation is not an issue at all, because when we buy and sell stocks and we incur short-term gains or long-term gains under our scheme or inside our scheme, we do not have to pay any tax on it. That way is medium term. I won't say very long term, because long term is a series of medium terms, when they come together. That's how long term gets created. And whether one stock did well or not well is also a function of whether that stock is good, not good. So there are many stocks which are good, yet they go down by 20, 30%. The best retail stock, for example, is down 30% in the last 6 months, because the price was high and it has come down right now. So I think there are different rules for different type of companies and investing. Not be able to answer that in a short period right now. Okay, so I'm done with 2 questions. Thank you. Thank you, everyone.
Thank you, sir. Thank you for sharing your thoughts on and the budget. I'd like to request Mr. Shyam, Sekhar and Mr. Niranjan Sridhar to present a token of appreciation to Mr. Kalpen. To discuss more on the Indian equity opportunity, I would like to invite Mr. Ihab Dalwai from ICICI Mutual Fund to join us.
Good morning, everyone. Thank you, ITHOUGHT. Thank you, Mr. Shyam, for inviting me and giving my organization an opportunity to present to your clients. So the topic given to me is Indian equity opportunity. So I'm going to talk about why one should consider Indian equities for the next 10 years. And second, I'm going to talk about how one should approach towards investing if one is a believer in the Indian equities. So I think most of us are here because we believe in the Indian growth story, because equities respect growth. Like over 30 years, equities have not delivered growth because growth is absent, has been absent in that country. UK and Europe is also an example for that. China, after 2015 and 16, after the soft landing issues, after the, we have productivity improvement as well, which will lead to growth. We have a large sector of people who are employed in the agricultural sector, which need to be uplifted to the manufacturing and service sector, which again will lead to growth. Second growth driver has been the structural changes which the government has done over the last 4 to 5 years, especially on the supply side. These are the reforms which you have seen either in GST, either in digitalization, introduction of IBC. These are like structural supply side changes which will aid growth. And lastly, this significant government impetus for driving manufacturing growth and infrastructural growth, especially what we have seen in the current budget as well. Government has focused a lot on capital expenditure. Government is trying to push manufacturing through the PLI scheme, which again will drive growth. One other key driver for growth, I feel, is urbanization. Today, like India and China both have similar populations, but our urban population dwelling in the urban setup is very low at around 35%. For China, that is around 65%. What happens through urbanization is that it absorbs a lot of unskilled labor. It reduces the cost. I think this is a very important point, that it reduces the cost of delivering social service to the population, especially education and healthcare. It reduces the cost of manufacturing as well, and it leads to, it boosts construction as well. So I think this shift we would see over the next 10 years, we would see our urban population growing, and this itself would drive growth. This is also one thing which I think is possible in the coming decade. what we are seeing is that there is a possibility of a structural shift in our balance of payment as well. What we have seen over the last couple of years is that service exports, especially IT service exports, has crossed the crude import which we do, which is very good from a balance of payment perspective. This again can improve us on the balance of payment level. Secondly, the PLI investment which we are doing today will help us reduce our imports or dependence on imports and can also boost exports. So over the next 10 years, what I feel is that all these changes can help us improve on the balance of payment. This will lead to currency stability and can possibly lead to reduce of cost of capital. This again I spoke about earlier. I think this is a very important chart, that Indian working age population is on a rise, very unlikely what we are seeing on a global landscape. On a global landscape, working age population is on a decline, whereas it is on a rise in India. Secondly, consumption itself would drive growth. If you look at the penetration level across various consumer categories, it is very surprising. Even I was surprised when I saw this data that auto penetration in India is only 4%. Air conditioning penetration is only 8%. Refrigeration penetration is only 18%. So the penetration levels are pretty low, and as income level rises, this penetration would increase. This is a very interesting chart, which, so the left-hand side chart is from a research group called Gavekal. So what it tries to say is that, so the graph divides the population on a normal distribution basis. So $10,000 is your average. So what happens when your average income increases by 25%? So the average income has increased to 12,500%. But what we fail to understand is that the households which are earning more than $15,000, it sees an almost 7 times jump. So there would be certain sectors or segments of the market which will grow in a non-linear fashion. A classic example is when you see the volume numbers which Royal Enfield as a bike has seen over the last decade. So it used to do 1 lakh volume, and that has zoomed to around 8 to 9 lakh volumes. Similarly, when you look at the SUV growth which we have seen, though passenger vehicle growth has been almost flat for like last decade, SUV segment has seen phenomenal growth. So that, I think, is one reason, because when your average income increases by a small percentage on a linear basis, there would be certain segments of the market which will see non-linear growth. The right-hand chart is showing the demographics, how it is divided in India. This is taken from a Morgan Stanley report. So over the next 10 years, what they estimate is that households which are going to earn more than $35,000. So currently we have 5 million households which earn more than $35,000. They expect over the next 10 years, this is going to increase to 25 million. So it's going to see a 5 times increase. Whereas what they estimate, the average income is going to increase only by about 2 times. So if one can find out or identify sectors or segments of the market which can cater to this segment, they can see a non-linear growth. It's very important for us to understand that there are certain segments which can see this growth, and we need not model the growth assumptions in these sectors or segments in a linear way. So that was the growth opportunity. I wanted to talk about how we should adopt, or the investment strategy we should adopt, while to take the benefit of the equity opportunity which we see. So this is a strategy which we try to adopt in few of our funds, internally as well at ICICI Prudential. So this table has been taken from a book by Rupal Bansali. She has written a book called Non-Consensus Investing. What she says that as an institution, what we need to do is that we need to find stocks or ideas which fall in the right-hand lower bracket, which is it has to be non-consensus and you need to go right. The issue, she says, that why people don't adopt a non-consensus style of investing is that they fear falling in the left bottom quadrant, because in case you go non-consensus and you be wrong, it is a bit of an embarrassment. It's always easier to be with crowd versus not being with the crowd. The tenet on which this thesis or this investing style is based on that, you need to divide the market into 2 groups, which is favored stocks and out of favored stocks. This is something what Mr. Shyam also spoke about in his presentation. So what happens with favored stocks is that market goes wrong on two counts. It gives a higher multiple than what the business deserves, and that higher multiple is on a very optimistic assumptions of earnings forecast. So you go wrong on two counts. So to make prospective money on a favored stock becomes very difficult. But whereas what happens with an out of favor stock is that market generally undervalues that stock, and that undervaluation is based on a very pessimistic earnings growth estimates. So what happens when there is an earnings surprise or some positive news in an unfavored stock? The stock goes up substantially. But if there's any earnings disappointment in a favored stock, it comes off because there are a lot of expectations built into the stock already. So this is something which we try to adopt while investing in our company. So people say, does this style fall into a value style of investing? What I feel is that one can easily adopt a non-consensus or a contra style of investing in any of the styles, but it's a style which you need to adopt in your investment approach. So to give one example is that PSUs fell into the contrarian style of investing, though it was a value approach of investing. So like a couple of years ago, if someone said we had PSUs in our portfolio, they would say, oh, why are you investing in such companies which are no growth or don't have bright outlook? But if you look how they've given returns over the last 2 to 3 years, it's been a good experience. Similarly, a two-wheeler company, it was a non-consensus growth investment. This is a Bloomberg's extract of what is the sell side's recommendation on this stock as on Jan 2018. So there were 23 sells on the street, whereas there were only 12 buys. So this, if you are buying this stock today, it's a growth stock. If you're buying this stock today, you are betting against what the street is expecting or building in. So this again is a non-consensus investment, but it falls under the growth style of investing. So the point I'm trying to make is that one can adopt this thought process in whichever style they're comfortable with. What I feel is that as we move ahead, I think there are certain quality segment of the market which is available at a reasonable price. Increasingly, that is falling into a contrarian or a contra style of investing. Second approach which I feel is to adopt a capital cycle or a business cycle way of investing. So we as analysts, we focus a lot on the demand side, how demand is going to increase. But what I feel is that supply side, analyzing the supply side is a bit more easier. What you need to do is you need to understand or try to figure out what is the industry dynamics. One thing you need to figure out is capital getting into the industry or capital going out of the industry. If capital is coming into the industry, the prospective return outlook is weaker. But if capital is exiting the industry, one can expect the prospective returns to be better. So one example based on the similar thought process was telecom space a couple of years ago. So after the entry of Jio, capital was leaving the industry because a lot of players found it unviable to continue doing business in the telecom space. So as a result of which, the return outlook after a lot of players exiting the industry had improved. So this is another way of looking or investing which we adopt while going about managing people's money. And this is the last slide which I have, which I think is a bit less appreciated generally. So the point I'm trying to make in this slide is that people just say, what is the alpha in a fund or how funds have done? But alpha in a down market has more or substantial value than alpha in an up market. So this, I'm just trying to compare two funds. Fund A is a conservative fund. Fund B is a very aggressive fund. So in year one, the fund A generates 30% return, whereas fund B generates 50% return. So fund B has generated 20% alpha over fund A. So, but what happens in year two is that fund A, which is a conservative fund, falls only 30%, whereas fund B, being an aggressive fund, falls 50%. So you say fund A has recovered the alpha loss, which was 20% in the next year, by generating an alpha of 20%. But what we need to know is that the NAV as on year two, fund A has a higher NAV at the end of year 2 than what fund B has. So on a pure alpha basis, we'll see that, oh, it's 20% loss. That's what they have gained back in year 2. But the alpha generated in a down market has substantial value than alpha generated in an up market. And this is what I've seen, like the legends in mutual fund industry, they may not be in the top quartile when markets are doing really well, but when market corrects or market comes off, they protect capital. Only if you can protect capital in a down market, you can participate in the upcycle. So this is very important. So one fund internally which we run on this thought process is our ICICI Prudential multi-asset fund. And this is the performance of this fund. So on an average, I would say during these periods, the fund would have had 65% net equity. But the fund has done substantially better than what a fully invested index, Nifty, has done over a long-term period and a short-term period as well. That is because we have inbuilt a thought process that we need to protect capital if we think market is overheated, and so that we can participate in the next rise. All right, that's it. Thank you. Yeah, happy to take questions if there are any.
So you were mentioning about non-linear growth in certain sectors.
Correct.
And if that is happening, how do you keep track your charts and updates? How often you update that to keep track of these non-linear growth? Because the demand keeps increasing. And the supply also supply chain to meet that demand has to equally come up. And how do you balance these things? Because there could be some critical components in the system for you to meet the demand. How it can be balanced?
No, I agree to your point that supply chain can face some issues if we face some non-linear growth. The best example is the current car environment which we are seeing today. So if you try to buy an entry-level car today, there's no waiting period. But if you try to buy an SUV today, you will have to wait 6 months to 8 months. That was the case at least a couple of months ago. One reason is because the chip requirement in an SUV or a premium car is substantially higher than what you need in an entry-level car. So chip requirement is the shortage. So, but I think we have good enough entrepreneurs in the country who would figure out and analyze and set up the supply chain as and when there is a requirement to meet such demand. But supply will need to catch up as and when this demand picks up, yeah.
But that may be dependent on something else also, supply.
Yeah, but we would need a long-term thought process to ensure the supply security of any, if there's a critical component or so. But I'm just trying to say, as an investor, one needs to understand that we just think that income levels are increasing by 6-7%. So any sector or industry which we are tracking, the volume growth would be 6-7%. But there would be industries which will grow way faster than what our average would grow. So we need to understand that when we are analyzing or understanding companies. That's the point I wanted to make, yeah.
Okay, thank you.
Thank you. Yeah, sure. No, that's the point, because if energy transition is happening and our dependence on oil or crude would reduce, I think that's the biggest import which we do. And if people understand that financial investment is better than physical investments, be it either through gold or so, a balance of payment is not that bad, or our import is not that bad. It's just that it's crude and gold which hampers it. So if you look at X crude and X gold, we are well balanced. And The PLI which government is incentivizing, I think it's a very good move because to reach to a scale, you need a bit of subsidy so that the manufacturing capacity comes to a scale, and because of scale, they can be one of the lowest cost producers globally. I think China has also done that by providing cheap power or cheap land or any other way of doing it. But I think this is a good move so that our manufacturing comes to a scale and becomes globally competitive, and then we can be an exporter. So I think balance of payment, which has been a historical problem, may reduce in the next decade. No, it brings currency stability. That's what I think few foreign investors also look at, how stable is the currency. And if your balance of payment is intact, that means you have sufficient savings internally to meet your investment growth. So your cost of debt and cost of capital will also come down in a country. So yeah.
Thank you.
Can I complete my question? Yeah. So one, with respect to ICICI, I like the value discovery fund, that is one. Second, with discussion with Naren and Shyam, there was a video where Naren gave a very interesting data that across the world, mathematicians are the one who are making money and not the financial people in the background, right? Then I checked, cross-checked, because there are some PhD professors who were my friends in US. Obviously, that some data was true, but what that you are going to do to outsmart that, because you are from the financial background?
So, so the approach, like I mentioned about a counter-cyclical or a contra approach, it's more of a behavioral approach. To adopt this approach is a bit difficult, and as an individual basis, because like I mentioned then was that the worries that you need not the embarrassment which one faces by being wrong, by being a non-consensus investor. That's a big embarrassment. So I think people just try to end up being with the crowd, trying to be with the stocks, which is the flavor of the market today, so that even if you go wrong, you're wrong with the crowd, so it doesn't matter much. So I think the behavioral edge in investing is a very key edge, which one needs to build in an investing experience or the thought process, which I think whatever robo-advisory or whatever mathematician or whatever modeling one does, I think it's difficult to build a behavioral edge on Excel or a fact sheet.
That I agree with respect to an individual perspective, but as an investor, how you will, being from a financial background, how you will outsmart the mathematicians who are making money across the world. That was my actual question.
Okay. But as a financial investor, I think understanding a business structure, understanding an industry structure is also very important. So if you think an industry structure is good, you can invest in that, because that's the role of an analyst or a research analyst or a fund manager as well. A quant fund manager or a mathematician may not be doing that analysis. I still feel that being a financial analyst, you can end up making money through research and understanding industry structure and conduct and doing a bottom-up research and making money.
I agree, but this data came from your...
No, I'll have to check what...
I mean, Shyam might be remembering, because this particular point was discussed there.
Okay, I'll have to check that. Sorry,
On inflation, your thoughts on inflation, and for a long-term investor, how will inflation going forward affect the investments and returns?
See, globally also what we're seeing is that the goods or the... so inflation is two types. One is goods and other is services. Globally as well, good inflation is coming down. What US is currently facing is service sector inflation. Like the job market is very tight, which is not the case in India. So if goods inflation is coming down globally, it benefits India. And if you look at India's inflation number, it's been very rare that in our history that we are seeing India's inflation lower than what we are seeing in the global landscape, which is good for India. And I think we're close to the high inflation, high rate cycle globally as well. It may plateau, it may not come down, but the incremental increase, I think we're close to the end of that cycle.
Thank you.
Okay, thank you. Yeah, okay. Yeah, thank you.
We do see a lot more people who have questions, but due to the interest of time, we'll take them offline, because our entire team is going to be available for networking post-lunch. So all your questions shall be answered by us then. I'd like to request Mr. Balaji and Mr. Shyam Sekhar to present a token of appreciation to Mr. Ihab. We all have heard that 2023 is going to be a good year for fixed income. So to discuss more on this, I'd like to request Mr. Anupam Joshi from HDFC.
Thank you and good afternoon all. Correctly mentioned that fixed income as an asset class is going to be a very exciting asset class, at least going forward for next couple of years. Why we think so is that interest rates have come up significantly higher in last 1.5 years. We had a post-COVID kind of a situation playing through, wherein most of the global central bankers suddenly found themselves significantly away from the target inflation mandates. They suddenly realized that inflation, which was earlier perceived to be a supply-driven problem, actually turned out to be a demand-driven problem. Why we think that the years to come by are going to be a very exciting time frame as far as the fixed income investing is concerned. So if we were to look at what has happened in last 1.5 years or so, interest rates in India, if we were to look at across the yield curve, the short end of the curve has risen significantly in last 1.5 years. We have seen 1-year bank CD rates are today at least higher by almost 350 basis points as compared to where they were in 2020. Even a 30-year price point trades at about 735, 740, which are the levels possibly lower than where your 1-year bank CD trades are. We think that with this kind of a move, it's a rare opportunity for investors to start locking in for longer when it comes to investing in fixed income. If we were to say what are going to be one of the largest drivers of interest rates in an economy, we identified a couple of largest macroeconomic variables, including growth. Like my previous presenters have said, that India growth story will continue to remain a very robust growth story for next multiple years to come. We also feel the same way that growth in India cannot be taken away, but the pace of growth potentially is going to be slower as we start increasing interest rates and there is a definite slowdown in the demand in the economy. So marginally slowing growth is definitely good as far as fixed income investing is concerned. We also heard about stabilizing of external sector. We are a net current account deficit country and we have remained that way for very long periods of time. And if commodity price is correct, it definitely benefits our country much more than it benefits anybody else in the world. So any current account deficit country, falling commodity prices are good. So we are seeing a significant signs of external sector stabilizing. Moreover, whole of last year we saw that the world over, all the markets were struggling with dollar strength and not necessarily a domestic currency weakening that we were talking about. A lot of that dollar strength is behind us. If we were to look at inflation with commodity prices falling, demand slowing down, inflation is likely to fall. The last uncertainty that we were living with was that it's going to be an election year in 2024. What will government do on the fiscal front? There were worries and fears around the fiscal policy, around the budget, wherein markets expected that they will definitely announce some populist measures. We have not done so much of spending like most of the Western world has done. And this will be the right time when they would want to go populist and try to garner as many votes as they can. Contradictory to that, we came out and we saw that it was one of the most beautiful budgets that we could have anticipated as a bond market investor. We think that the budget of this financial year is one of the most delicate balancing act that the finance ministry seems to have achieved. No matter what numbers that you look at, the numbers are very credible, whether that be on a nominal GDP growth estimates, whether that be on revenue growth estimates. a significant cut in the subsidy bill, a significant increase in the capital outlay. I think it ticks all the boxes as far as, any researcher or analyst as far as the budget outcome is concerned. So I think most of the negativities or uncertainties that world was living with until about 2022 as to when will war end, how high the commodity prices will go, where will inflation peak, how high will central banks take their interest rates. I think a lot of these uncertainties we now have an answer to. And hence we think that with all this clarity emerging, it will be a wonderful time to start locking in for longer when it comes to fixed income investing. Especially when we are going to see that monetary policy cycles across the world are not going to repeat what they have repeated in last 1.5 years. For example, US has already hiked interest rates by about 450 basis points in last 1.5 years. India has raised rates by about 225 basis points on repo rate and another 40 basis points on reverse repo rate. A cumulative rate hike of about 265 basis points. We don't think same thing is going to happen over next 1.5 years. We might have 1 or 2 more rate hikes coming from developed market central banks, possibly 1 rate hike coming in from RBI itself. If we were to see, so hence we think that, the worst of global inflation and rates seems to be behind us. We have seen the rate hike expectations are starting to taper off. We are seeing that commodity prices have come down, supply chains are easing off, leading to a situation where we can be much more confident in investing into fixed income now. Will India continue to follow? We have a question mark always that India never had a problem of inflation like most of the developed market economies faced. US inflation today, like my previous presenters also mentioned, that this is for the first time we are witnessing a phase where India inflation is actually lower than developed market economies. So now will we disinflate as low as some of the developed market economies are going to do? Possibly no. But direction definitely changes as far as whether if you look at if you were to take last calendar year, for example, the trailing WPI inflation was in double digits at about 13-14%, and the CPI inflation was at about 6 to 7%. This was because of weak demand conditions back in the economy, input prices not getting passed through into the output prices. Thankfully, a lot of that WPI inflation has now turned, and now your WPI inflation is actually much lower than your headline CPI inflation. So I think it's going to be a softening inflation regime for some time, and the signs of inflation softening are definitely coming up. Like we mentioned, the commitment to fiscal is a very strong positive as far as bond markets are concerned, and we think that the thrust on capital spending puts you as an economy on a very strong footing. Why we say that is because a lot of this spending turns out to be a revenue generating asset for government at some point in time in the future. So this is not money spent and money gone down the drain. This money definitely comes back as a revenue generating asset for the economy as a whole. Now, most of the investors, still have a mindset that RBI abhi bhi rate hike to karne wala hai. There is going to be 1 more rate hike. Fed also is going to hike rates over next couple of policy meetings. Why should we invest now? Let us wait. Let RBI stop the rate hiking path, and we will possibly locking at the highest possible yield curves. Just like, people have tendency to discount forward earnings in equity markets, bond markets also have a tendency to discount the future central bankers' move much ahead of anticipation. So if you were to look at most of the monetary policy cycles or interest rate cycles, we often see that bond markets are first to react, and possibly central bankers will always follow through. The reason being that bond markets are definitely much ahead of their anticipation of how the future course of monetary policy action is likely to follow. Because unfortunately, the monetary policy has 2 or 3 difficult balancing targets that they need to pursue at a particular point in time, and they typically tend to go after the most relevant at that point in time. So if you were to look at the price stability, the growth, or the exchange rate stability, at this point in time, whatever is important, the maximum focus will be on that part of the monetary policy in terms of the rate action. But bond markets will continue to look through this as to what is going to be the second round effect of this and how interest rates are likely to behave over the next 12 years. So we have time and again seen that the bond market or the interest rate market movements will typically preempt a lot of policy actions beforehand. So if you look at US 10-year bond yields have already rallied by over 100 basis points in last 1.5 months, at a time when US Fed is still hiking rates. So in fact, day before yesterday, US Fed hiked rates by 50 basis points and bond yields have fallen. Because the new guidance from the Fed seems to be coming out that rate cuts are expected somewhere as early as end of 2023 or somewhere in the first half 2024. So bond markets will typically tend to peak out much before the policy rate is going to peak out or start hiking rates or start cutting rates on both sides. So it is always better to look at the emerging signals that the yield curve is pointing at, what the consensus estimates of markets are as far as the structural or the long-term interest rates in the economy are concerned, rather than waiting for RBI is going to cut rates or RBI is going to hike rates and that would be the time when we would start investing. Don't do that. We think that when it comes to fixed income asset investments, we think that asset allocation is going to be of very, very important nature, especially in times like these where we think that it's going to be a multi-decade opportunity that we are going to witness. Now, just to give you a perspective, the first GSEC auction that I saw in my career, I started my career was in 2001. The first 10-year GSEC auction that I'd seen was 11.5% 2011 back in 2001. And this was coming after 250 basis points of rally all the way from 1997, 1998, and we had bonds with the coupon of 1385, 1422, these kind where the coupons where Government of India was borrowing money for 10 years and 12 years and 15 years, so on and so forth. We saw a low of about 5% in 2003. Since then, we had multiple interest rate cycles, but what we have observed is that the trend interest rates in the country are definitely coming down as economy progresses. I'll cover more on that in the future slides. But we think that asset allocation when it comes to fixed income investing is going to be very, very critical, like Shyam mentioned earlier. Indian investors typically tend to have much lower risk appetite as compared to what we think we have. A lot of money gets deployed for 3-year investments, 5-year investments, 10-year investments, but we start worrying about 3-month returns are looking bad. I think we should get out of this fund now and rethink our strategy 6 months later. Unfortunately, what we have seen, a lot of mistakes typically tend to get made when it comes to investing, whether that be on fixed income and equity. We think that asset allocation is key, and we think that long-term debt funds today makes a very strong and compelling reason why it has to be a very integral part of some of the investors in the country or all the investors in the country today. If we were to look at within the mutual fund space, the space on the long duration has emerged very recently. We used to have typical products which were positioned across the yield curve, by virtue of your cash requirements getting parked in overnight funds and liquid funds where you invest in typically up to 1 or 3 months. Then you have to, if you had pools of money to be deployed between say 6 months to 12 months, you had a whole host of products between an ultra short-term fund, a money market fund, or even a low duration fund. And then for 1 to 3 year, which typically tends to be a corporate investment horizon, we used to have products like short-term bond fund, medium-term fund, and medium to long duration funds. There is a new category which now has emerged, which is the long duration funds over last couple of years. It will be very, very important to try to time and take advantage of the interest rates which are prevailing in the economy. Once you have a very long gestation cycle coming through and interest rates peaking out, it would be possibly the best time to start locking in for longer. So we think that long duration debt fund today makes a lot of sense for investors, especially investors who are sitting in this room, because structurally, we think that India's growth story, typically you don't see a bond market or a debt fund manager talk very positively about growth. Now, if you were to take structural trends as far as what India is going to be over the next 10, 20, 30 years, we possibly are going to be one of the fastest growing economy for very long periods of time. And from our experience, what we have seen in this country and most of the neighbors that we look at the pace at they have grown and how interest rates in their economies have evolved, what we see that India is projected to be at top 3 economy by 2050 and project to be the second largest economy in the world by 2075. So if this were to be true, we have seen across the countries that as economy evolves over the macroeconomic landscape, the structural or the trend interest rates in the country will start falling off, and it comes off at a reasonably faster pace than what we could have envisaged. So like in past 20 years, I have seen trend interest rates in this country go down by almost 4%. Possibly another 20, 30 years, we may see another 2.5% fall in interest rates structurally in this country. Why typically this happens is that as economy moves up the value chain, or as the economy starts growing on a per capita GDP basis, the people start saving more than spending more, because you are starting to earn so much that there is a limit to which you can ultimately start, end up spending. So I think from that perspective, we have seen as economy moves up the value chain, structurally we will see interest rates in the country fall over very long periods of time. And hence, we think that a long duration as a strategy is providing you a fantastic opportunity to lock in rates for longer. These are rates we have not seen in a long time when it comes to whether your 1-year rates, or whether your 3-year bond rates, or whether your 10-year, 30-year rates that we are seeing. Interest rates across the curve over last 1.5 to 2 years post-COVID have risen by anywhere between 100 to 350 basis points. Last 10 or 20 basis points, if you are allocating for long term, definitely does not matter. If it gives you an opportunity to invest 10 or 20 basis points higher, we would advise investors to start locking in for longer. That's what we had to say. I had to say. I guess I have 2 questions.
Hey, hi, good afternoon.
Hi.
Thanks for the presentation. I have a couple of questions. So where do you see the interest rate peaking out, right? So 10-year yield peaked out at 7.6. Now it is somewhere around 7.3-ish. Do you think, it will go further? Will it touch 8, or this is the right time?
See, what we think, it is very difficult for us to pinpoint where the yields will peak out, what number. We unfortunately do not have any mathematical models which will give us, okay, for this inflation, for this growth, this should be 10-year. But what we have seen that we are better predictor of direction on rates. I think directionally rates seems to be headed lower over next 2 to 3 years is what we think right now. I just hope and wish we had some magic formula which would have told me that 10-year is going at 8%, and you just go back to what happened on 4th of May when RBI hiked by first 40 basis points, 10-year went to 7.6, and market was waiting for 8% on 10-year since then, or market is still waiting for 8% on 10-year GSEC to come so that we can start investing. What we have time and again seen that what most of people are waiting for never comes. So just like people were waiting for index to correct by another 20% in 2008, it never happened, right? It just recovered back from that. So I think when we are talking long-term investments, or when we are talking about structurally interest rates have peaked out or risen by 100 or 300 basis points, last 10 or 20 basis points are not going to move the needle or make a lot of difference if you are trying to create, say, a retirement pool of savings. So whether you invest at 730 or 740, 7.5, you spread it out over next couple of months or quarters, that's the best that you can do.
Okay. Second question is around the duration risk, right? So do you think this is the right time we can start taking a longer duration risk, like say a 20, 30-year papers?
Yes, very much. And why we are very comfortable in recommending our long duration funds. So the strategy that we are going to follow here is simple. Buy 2050 to 2055 maturity bonds, which is average 30-year average maturity portfolio, and keep on buying these assets till the time you are getting closer to the maturity of these papers. So for next 20-25 years, we don't have to worry about buying into any other pools of bonds right now. Why we think it makes interesting to be here? Because we think that most of the macroeconomic variables are now pointing to the fact that whatever interest rate hikes central bankers have done, whatever liquidity withdrawal from the system has happened, leads to higher interest rates, automatically demand coming off in the economy, showing slowdown in growth and slowdown in inflation, which means that clamor for rate cuts will start sooner than later. So investors today are prone with reinvestment risks. If you are fearing that 1 year forward when my investments mature, I will be able to invest it only for a lower rate of return than what they today are, we would recommend you to invest for longer today and lock in for longer right now. So that's what we mean when you say increase your duration.
Okay, thank you.
Hi, here.
Yeah.
I wanted to know, we are basing everything on growth. And in the previous presentation, we saw that China, UK, Japan, at a point, you know, the growth didn't happen. And that's why a growth mindset investment doesn't work there. So what are the factors? So why is India still focused or has a growth mindset? And what will continue to, you know, you said it's going to happen for the next few decades. So what is it that's boosting it? And what are the learnings that we can take from China, UK, or Japan to avoid the growth mindset becoming stagnant?
So India, I think we are at a very early stage of the growth or the development, if we were to say. If we were to look at the transition of how structural interest rates in India have behaved, as the economy makes a transition from an underdeveloped economy to developing economy to a developed economy, we see that the per capita GDP of the country increases as the size of economy increases, and the number of people we assume are more or less going to remain around the numbers where we are. So as the size of the economy increases, and if we were to, you know, draw comparisons, we possibly are at a stage where possibly China was 20 years before. So, and you see what has happened to China growth story in last 20 years, right? You cheap labor, you have, you know, governments giving you good policies to make your manufacturing better. China plus one story playing out, so everybody wants to diversify their supply chains out of China, and India comes out to be a very wonderful opportunity. So I think from a structural standpoint, India growth story continues to be very, very attractive. For a fixed income markets, what it means is that for you as a consumer, if you start earning 20 times more than what you are earning today, you are not going to consume 20 times more than what you are going to do today, which means your savings rate in an economy picks up. The problem that we face today is that we have to import a lot of capital, and we continue to remain a current account deficit country. So once you start saving more, you don't need to import those capital outside of country. So I think from that perspective, we still have a very strong reason to believe, like the equity market presenters have said, that demographic dividends of this country are very strong, and they are likely to remain that way for next 10, 20 years or so. So working age population, for example, in this country is the youngest that we have. The quantum of labor force, you know, that you can supply not only domestically but to rest of the world will continue to remain growing for at least next 10 or 20 years. So I think that India growth story continues to remain very much intact, though we may debate that the pace of growth is going to slow down. So while we used to be an 8 to 10% real GDP growth and 8 to 9% inflation, so an 18% nominal GDP growth rate country 20 years back, we have fallen to about 10%. But even at 10% nominal GDP, we are still the fastest growing country in the world. And we possibly will remain that way for next couple of years. Yeah.
Sir, questions from the YouTube live chat. I've just punched them up together. So on inflation, and given the Russia war situation, so you're also saying that the yields are likely to peak at these rates. So what are the good options for investment in fixed income? Should we go with hybrid conservative funds, or should we just go with pure debt funds? What options do you suggest?
See, like I mentioned, asset allocation is going to be important. The whole of last 1.5 years, fixed income was going through the pain. So in fact, there were a lot of post-COVID monetary policy, aggressive monetary policy and fiscal responses which were doled out not only by the emerging market, but surprisingly by the developed market central banks. What this has led to is that 1 year down the line, when economies came back to normalcy, we realized that the inflation problem was much bigger than what was anticipated earlier. And central bankers had to mount an interest rate defense which was much larger than anticipated to start with. Now you are here when US, for example, have raised interest rates by 4.5%. We are definitely going to look about the slowdown in growth coming up over next foreseeable quarters. The pace of disinflation is definitely going to happen. So you might slow down from 8-9% inflation all the way down to about 2.5-3%. So while we are not saying that interest rates are going to go back to the normal times what we had seen into the COVID or pre-COVID times, they will definitely be higher for a longer period of time than the trend rate of interest rates were. But they definitely are going to be lower than they were currently are. So in this kind of an environment, as long as you see that direction on interest rates has started turning, and investors have to now start actively worrying about that, if I am invested for short term, when my money matures and it comes back for reinvestment, I'll be deploying that fund at a lower rate of interest than what are available today. It is better to start locking in for longer. So now the investment horizon will definitely guide these. So there would be somebody who might want to invest for their retirement income or create an alternative source of income at the end of a 20-year or 30-year. For them, long duration debt funds definitely makes a lot of sense. A corporate treasury was sitting on an ultra short-term fund or a liquid fund or a overnight fund. Definitely a low duration fund or a short-term bond fund will make a sense. So all we are saying is that move up the duration curve where you are currently at. Identify your investment horizon and choose a product accordingly.
Thank you. Thank you, sir.
Thank you, sir. Thank you for sharing your thoughts on fixed income. I'd like to request Mr. Shyam Sekhar along with Mr. Rohit and Rajat to present a token of appreciation to Mr. Anupam. We'll take a short break. There's tea and coffee being served outside. We'll resume in 10 minutes, which would be 12:25.
Hello, this section. Hello, check, okay.
Just request everybody to settle down so that we can start in a few minutes. Request everyone to be seated. We will begin now. Rendering advice is a very difficult business, whether you advise a friend or a client. The natural tendency is always to first question the advice, often sit on it, and at times ignore it. Actioning advice doesn't come to most of us naturally, but this is exactly what an investment portfolio needs. Timely actioning of good advice is the most important thing. This was a biggest pain point for us in our ITHOUGHT journey. But the good thing is we learned how to solve it. We felt the need to productize what would become a good advice to every client. While productizing, decision-making and execution also became ours. The result of this is our sphere. Talking about this product is Mr. Niranjan, who has been in the journey and evolution of this.
Thank you all. I welcome you all back in. I'm Niranjan, and I'm going to be talking about multi-asset investing, the Spear way. What do investors really want? They want to participate in the performing asset classes. They want to get their asset mix right. They want to be able to measure all their investment performance easily and to achieve their financial goals. So how does one get to what they want? I am going to present to you a way that we worked over the last 12 years here at ITHOUGHT. Believe me when I say that multi-asset investing is so powerful that you can actually get asymmetric returns very easily on that. This means that your portfolio is more stable, less volatile. It also means that you're taking less risk for more returns. You also have superior risk management in place. And finally, you have all the product and asset diversity that you would ever need. Take a look at this chart. What does this chart tell you? It's a very interesting mosaic. It's the chart that shows the return of all asset classes over the last 12 years. It shows that winners can become losers very easily. Case in point, let me just point out to one bit. You look at 2016 on top of the chart, GSEC, it had delivered 16% on that year. But then look at 2017, what had happened. It had gone to 2%. And also, losers also can become winners very easily. Again, case in point, look at gold. Where was gold in 2021? That's the most recent thing that happened. Gold did nothing. Gold was probably the worst asset to be into in 2021. It has done a negative 2.7%. Look at 2022. Where has it moved? It's on top of the class. This chart also gives a very important takeaway. That takeaway is that no asset class stays in the top 3 for more than 3 years in succession. This means that you can actually master the market cycle. Now, just take a look at this. This is a very straightforward way that's worked in the past. This is a traditional 60-40 equity to debt portfolio. Okay? This would roughly give you about a 9% CAGR over many market cycles. But then, we arrive at the dil mange more moment. Who doesn't want more? We all want more, right? If investors want, say, about a 12 or a 15% CAGR, how can they achieve this? We have been able to achieve this using the PMS edge. The edge is in efficiency. Our deployment is very gradual, we are very cost conscious, and we're very timely. And not only that, your costs are lower because we add a lot of ETFs on the portfolio, and we also add a lot of stocks on the portfolio. And then the investor experience has to be uniform. In Sphere, we've been able to do that. And then the other thing is that there is room for every investor to scale up, because most often or not, most PMS products, the scalability is a question. So a PMS makes multi-asset investing better in a way that it works for everybody. So what makes Sphere special? It's sheer experience. We've had 12 years of product development. This is backed by real-time performance validation and not any hypothetical backtesting. We have proven product versatility and the ability where we have been able to shift out of assets as and when we deem it fit. And lastly and most importantly, Sphere brings your world of investments to one place. This is a very interesting thing that we did over the last 3.5 years in our advisory practice. So this theme is the pharma theme, okay? So this is a journey of 3.5 years for our investors. Between November 2017 and probably the first week of March 2020, it went nowhere. We had advised clients, but however, we had advised clients to buy pharma. And at this time, pharma tested every investor's patience. And nobody wanted to buy it, honestly. Why would you want to buy an asset that's moved nowhere? Just have a look. It's gone nowhere. And then, I would say, it suddenly took off. Then they started doing really well. And every investor wanted to be in. This was a time at which we decided to walk out of the asset. And even when we walked out, we were very staggered in our approach to walk out. So the other point that I also want to bring to your notice is that there is always a choice of doing the things the easy way and going the extra mile. We prefer going the extra mile. I give you the case in point for gold. What would be the easy way for gold? You buy your gold ETF, you buy a gold mutual fund, and you're done. The extra mile that we created here at ITHOUGHT was that we bought gold mining funds, we have silver, and we have ETFs. So we have 3 products against 1. And this has done extremely well for us in the recent past. Going the extra mile is something that we do whenever we like a theme. The investment universe is very large. You've got 1,000+ mutual funds, then you've got about 200 ETFs, and then you've got about 500 stocks. With Sphere, the end result is a portfolio that contains the very best. And we have filtered out 30 of the best securities from this universe just for you. So what else can Sphere do for you? It can help you create wealth very sustainably. It can protect you from tough market conditions. It can make your investment portfolio more versatile. It can align your portfolio with your goals. And you can bring your entire world of investments to one place. Before I close, let's talk about what you can do to win. First, be patient with the themes. Case in point, pharma. There are a lot of themes that keep playing out like this. The key is patience. Second, buy the right asset at the right time, simply because winners can become losers very quickly. Thirdly, engage with opportunities when you see them. and also be consistent in your investing. And lastly, focus on your goal. So who's fear really meant for? It's meant for somebody who's systematic, who likes different flavors of investments in their portfolio, and those who are on a mission to achieve something. A very funny thing is that the biggest pushback that we had from a lot of people when we curated this multi-asset portfolio was that a multi-asset portfolio cannot do as well as a pure equity product. Well, here you can see the proof for yourself. The proof is in the numbers. We have done exceedingly well on an aggregate figure. And even better, if you were to be looking at what the respective benchmark has done and the indices have done. And because of this result that we had a lot of recognition that came to us this last month. So I'm done with my presentation. I would be more than happy to take any questions that you guys would have on this. Yes, please. Yes, see, we are very asset agnostic. We buy domestic, we do buy international. In fact, we do have international exposure through the international fund, where we bought the underlying asset as an international fund. So we are very asset agnostic when it comes to investing. Yes, please. I'm sorry. For the pie chart, yeah, thank you. So look at this. If you were to see the yellow, where we have precious metals, I don't have just precious metals in my portfolio. I do have mining funds. I have international mining funds, and I do have silver on it. And on equity bit, you see the light blue color one? That's the ETF. I do have NASDAQ also on the portfolio where we are now. Yes. The other multi-asset funds, they have a fixed ratio in which they have to be in any asset. Hello? Yeah. The other multi-asset funds that are there in the industry, they have to have a minimum weightage no matter what happens, no matter what, on that asset. For us, that's not a constraint, which means we don't really have a lower threshold to which we are bound to, because there can be some assets that will continue to underperform for a long period of time.
So one question in YouTube Live. Predicting right asset and right time is difficult sometimes. What went wrong sometime in your 12-year experience?
We've been early. A lot of investment calls that we've taken, we've been early. That I think has been, the case in point would be pharma. Pharma tested everybody's patience. Poonam, can you move to that pharma chart? Yeah. You look at this. So what happened in pharma? Anybody in the sense, the right frame of mind would have shunned this investment, right? But the beauty is, it took us 2.5 years. While, yes, COVID did accelerate the returns, but even otherwise, we were quite sure that this result would pan out over a longer period of time, simply because the business was still solid. A lot of people don't recognize that the business was still good. We had a lot of FDA restrictions that were there on the United States, that were put from the United States and India on the Indian pharma companies. So which was like a millstone on a lot of the companies, and that's the reason they had not done well, while their cash flows were still solid.
Thank you.
Yes, please. As I said, no, for us, we were early on investments. See, for us, when on the wrong theme, what happens is, see, our position sizing is small. We don't take a large position size. Our position sizing is very gradual. In fact, my team can vouch for it. It takes us quite a bit of time to build into the portfolio. It takes us at least 90 to 120 days to build into the entire portfolio. So we see if we can course correct at every point in time, and every decision is small. There's no decision that's large. The propensity to make a wrong decision comes when your decision sizing is large, because it doesn't give you the ability to course correct at the same pace. Say if you take a 10% position on something and where you're pretty sure on how it can go, right? But then what happens? Say the stock corrects, the idea corrects, say 20, 30%. Do you have incremental capital to add to it? Most often not. So as fund managers, what we try to do, and I think I speak for the entire house on that matter, is we don't go and take large position sizes anywhere. We are very gradual in our position sizing. And that's I would say that's the cloth in which we are all stitched on.
Hello, can you hear me?
Oh, yeah.
A couple of questions. Number one, so far have you invested on any of the debt instruments in this sphere? If not, are there any plans going forward? Second question is, you had shown a performance of 13% and odd since inception, but since it's a PMS, it's a customized product for specific investors. So from a layman perspective, how would you explain the performance for individuals? Because different customers enter the PMS at different points in time, and because of valuation, the portfolio mix definitely would be different for different customers and so on. So how would you explain that performance when customers enter the PMS at different stages? Thanks.
See, yep. Thank you for the question. So let me just address first part of the question on debt. We do hold about 20% in cash at where we are. So it's cash and cash equivalents. So we are the shorter end of the spectrum at where we are right now. Hope that answers your question, because we see it from your previous speakers also. We had seen that being in the shorter end of the curve is a much better place to be in, and that's the reason we are also in that space. But that doesn't prevent us from, if we find that there's a large opportunity where I can participate in debt, we would not hesitate to participate. And to the second part of the question that you would ask as to, for the investors, every portfolio, see, basically each of our portfolios are not, we don't run a model portfolio. Because we don't run a model portfolio, we see what investments we can buy at that point in time to populate the portfolio. And even that's done gradually. So on a 2-3 year period is when you would see most investors' portfolios congregating. That's the reason, and it takes a little bit of time for the portfolios also to, I would say, come in sync. Yes, please. Sorry, sir? Yes, thank you. Two things on the portfolios. As far as the recession is concerned, whatever recession that you're speaking, we are hearing of, is already factored in by the stock markets to a large extent. Unless there is I would say, a black swan event that can happen, that's where you would not, where nobody knows what's going to happen. But in terms of where we are on the portfolio, we are using gold and the allied assets as an inflation hedge, because that also becomes a cash call when things turn around. And I think because of lack of time, I might not be able to answer your questions here. I'm more than happy to take it off the tree. Thank you so much.
Thank you, sir. A PMS in equity is seen as a product which maximizes returns. Risk is somehow left to the fund manager's discretion. Judgment on who makes the maximum return, and the actual investor in this process is you, not the manager. A product must be made to suit you, and that is exactly what Solitaire is all about. Solitaire is about taking low risks and making our targeted returns. I would like to invite Mr. Balaji to take over.
Thanks, Rashmika. Good afternoon, good morning to all. Let's start. The topic given to me is art and science. The science part is pretty easy in investing, and I think I'll be focusing a little more on art. So, before getting into the frameworks in terms of art, what's the philosophy of Solitaire which we preach? The first and the foremost is the long term. And long term generally well not defined, right? People have long term in their own language of 1 year. Some people will have 1 month and even 10 years. Broadly, I believe 3 to 5 years is a long term. Why? You will have close to 9 to 12 results coming out, so which gives you a good data point to assess the company, and a good expectation from investor also to stay investor for 3 years. So every decision of us, we have institutionalized in such a way where today we write 2027 or 2026. It means 3 to 4 years, right from the analyst to me to the founder. Non-consensus investing, as a house, we are clear in terms of the way we invest is where the market crowd is least. Why? What is known, what is unknown is where the beauty lies, right? So we try to seek some value where the crowd is not there. I'll try to connect this with my end, where are we seeing value, right? So you will see some connection with the philosophy consistently. We are truly a bottom-up in Solitaire. Clearly, we go by company, we go by sector, and we go by country rather than from top down. It means clearly we find a company which is worth doing its business right, getting the product right, getting the sales strategy right, getting the final execution right. Then I think we are all in for the company. And finally, the last but not the least, the famous quote is, the management does the hard work of daily running the business. And as a capital allocator, my biggest job is to manage the risk. Because India is a growth country, we have been very fortunate. Between 10 to 12% nominal growth is reasonably expected for next 10 years. So a good corporate will do 10 to 12 to 15. It's like a broad thing. What we are supposed to do as an allocating your fiduciary capital is invest at right asset at right price and manage the risk better. And obviously, right, I'll have a lot of data to share. Spoken about the philosophy. Now let's get into what is a USP of Solitaire. Clearly, there are 4 cutout USP. It's a very customized portfolio built for you. The one call out is the entire portfolio will not have any lending companies. I mean, if you see our index, 35% of the portfolio, which is broad, NSE 500 or Nifty, is banking or the financial services. We have 0 lending business. It means it becomes a very, very complementary, customized portfolio, which portfolio of future. In the past, we invested into a company which served EV, hydrogen, and so on and so forth. Obviously, right? They have ramped up, and obviously, it didn't deserve a place now. We are very opportunistic. It means I'm a strong believer. There are close to 200, 250 good companies are there. You study when they are good. Not necessarily you have to act when the research work is done. Typically, our work happens between 30 to 40 days on the entire project. So couple of last 1 year success came from 2020 work, which we did the work, but we did not like the price. And when we got a chance, we loaded the truck. And obviously, right, the proof of the putting in the eating, which you'll see, how did we arrive at the numbers. And finally, if you have done all the 3 well, buying good company and what and so on and so forth, the last thing expected is don't churning, right? There is no big activity. We're a strong believer of activity doesn't mean productivity. A real quality decision is what you needed, and you don't have to take decision every single day. So our first client, our churn ratio is less than 0.2, clearly reflects it's like 6-7 years of holding. I'm sure this is not something which is normal in the market. We're trying to try something which is a long-only fund. So what's a good investment, right? So we all speak about good investment. For us, good investment is only 2 things. And I like always equation as a head of research and co-fund managing the fund of True Blue. Strong fundamentals. Really, really, you have to buy a good asset. There is no second choice. We start spending 85% of the time broadly seeing is the asset is good. But having decided the asset is good, what in the last 2 years with COVID and free money, people somehow went is, the young leader, what happens naturally, they end up becoming close to market leaders, right? What do you expect from a great team when Dhoni was driving? We come to the top. So strong leadership leads to market leadership. the market leadership leads to good profitability, right? It's a natural outcome, right? If you become the leader, you will be able to charge a little better. You will be able to control your working capital better. Your cash profile and free cash flow will be much, much better than the peers. So profitability-wise will be much, much better than the system average. And once you have a good profit, the end outcome is you will have a very less debt or a no debt, right? Like all of us, as individuals, a no debt is a great position to start. And all this 5 gives you what? Only one variable, a good company. But then the last thing is reasonable valuation. It is a debatable, there is no easy answers. But buying at anything at any price, I have a couple of data to share, might not be a wise thing to do from an investing point of view. So how we tied the philosophy and the USP, right? So I'll share the next 3 slides in terms of showcasing the proof of the pudding in the eating. The portfolio quant. In Solitaire, we have close to 36 stocks as we speak. At client level, it is 25 to 26. So what we do is we don't run the model portfolio. Every client, as they come and they give capital, we keep deploying money. So, but that's why the 36 is at the aggregate level. At disaggregate level, at client level, it will be 25. But most or all the entire 100% is in top 1, top 2, top 3, and well mix of large, mid, and small. So we are very cognizant of it should not be run risk. So we have a very good position even in large cap, which generally you don't end up seeing in a multi-cap portfolio, which is heavily skewed to mid and small. We are very clear in last 1 year, the big success came from large cap because in a volatile environment when the Fed is tightening and the policy rates are going up, you need a very liquid names, and that's where the large cap weights have gone up substantially. So we have market leaders, as I've told in philosophy, right? We buy leaders. That's point number 1. Point number 2, as Rashmik alluded, we're a strong believer of taking low risk to attain sustainable return. And again, the evidence is the entire portfolio doesn't have a lending, right? So I sum the 100%, we are half the risk of the index. So 19% of our portfolio has debt, and that's a very marginal debt, I would say. And lot of companies are debt-free, cash-rich. Actually, they benefit out of rising interest rate because they earn more treasury income, and few treasuries have come, they can understand, right? So these are really, really rich cash balance sheet company with a low risk. That's point number 2. The third one, again, one of the very principal architecture where we work very sincerely is on the balancing of the portfolio. Because if you see index, our index at times get very skewed, right? So banking is 37, 38%. IT in the peak of 2020, bull run on IT was 18, 19%. It means it's like 2-3 sector gets all the weight and next 10 sector gets only Namke was weights. Hopefully here we are trying to correct. We have a very good balance of weights from FMCG. Capital goods is basically industrial products, and we have financial services close to 15. It means we don't have anything on 25, 30 or like well-balanced portfolio because as a house we clearly take a view of probabilistic investing and not a singular investing, so that the portfolio is far stable and far robust, and that's how it enabled in the last 1 year with so much volatility. So having shown the portfolio quants, which concur to what the philosophy, let me share how we go about looking for the company, right? The thinking, because the thinking could be consistent and the views change based on market context. So what's the investment framework? The first framework is patience. My colleague Niranjan already spoke about where a true believer of patience is something is rewarding provided you are with the right asset. And I think no better company which got all the memes in the social media, but yesterday they came with the rock busting numbers. So this stock we were having between 170, 180, 200. It did not do anything. But the financial performance was weak. Stock was down. COVID, right? I don't think ITC can control that. Fine. But post-COVID, the financial performance improved, the stock did not improve. This is where the difference lies. The fundamental, which is cash flow growth, EPS growth, free cash flow is growing, but the stock did not move. And finally, in the last 1 year, the stock has gone up 67%. And with yesterday evening blockbuster number, we don't know what the outcome, but it clearly reflects as long as you have a good company which is growing top line, growing bottom line, generating free cash, and investing well, and you bought at 15 times with 5% yield, I think you have taken care of the risk, and now only the market has to reward. It's fairly got rewarded. We still hold this position. The second framework which we consistently think is investing is counterintuitive. What I mean is, so this is a picture which is on May 18, 2020 in the midst of COVID. COVID-19 impact, no comfort in hotel stock, right? What does it mean? Don't ever touch hotel, and if you have hotel, what you're supposed to do? You're supposed to sell, bech do, right? This is a straight thinking, nothing wrong. That's what they meant to be. But then, as an analyst, my only job is, right, go back, time travel. Since now we are in 23, I can always go back and check. And interestingly, Nifty has done 95%, which itself is a good call, right? I mean, if you would have invested in Nifty, it's the best decision. But I think all the hotel stocks did between 1x to 3x of Nifty. So clearly, it reflects sometime we have to think slightly ahead of and counterintuitive pays off. Not every time, but at times. The third framework, seeking long-term performance. We are a truly long-term, as I've shared, my portfolio turnover is 0.1, 0.2 less. This is 4 private banks out of Nifty. This 4 private banks out of Nifty, if you see the orange graph, for the first 2 years, everyone would have loved the stock, yes or no? It was beautiful, right? Consistently outperformed. But then came the risk, right? In a lending, I keep telling, the profit comes short term and the risk comes in the back end. And in the long term, you know, right? Clearly, one stock imploded, the rest 3 did very well. So my only thing is, we always keep thinking, sometimes there are stocks within the index do extremely well for its own reason, non-fundamental. And it's very much possible in time I'm speaking where one more index stock is imploding, right? So my only thing is, when you see underperformance, we have to see, is the fund manager has not taken risk and is underperformed. I think that's a good underperformance, because when the risk comes in, you will start appreciating. And here we saw one Nifty company went out of the Nifty, right? After lost 98%. I'm sure you would have got the name. The idea is not to give the name. The idea is, at times, some stock do extremely well, and your portfolio manager will never have it because he feels it's more risk, and the risk will come at some point. The fourth, I think this is the most important slide, for me at least I thought through, is this is a 50-year data of Walmart. We know this company, I'm sure we really cherish this company, is a benchmark for retail. But the big lesson I want to share with our well-wisher is, if you see Walmart listed in 1972 roundabout, it did 1400x in the first half. Big money, right? 1400x. But the next 23 years, it is only 1x. It means that someone invested 100 rupee, become 200 in how many years? 23 years. So all it matters is, it is the best company, no second question. But if anyone says, right, buy the best company, forget long term, buy Buffett, all good, but sometimes data suggests there are companies that doesn't deliver 20, 30, 40-year return. I think all our investment period is between, in my sense, 20, 30 years, right? Maybe 40, 50, or very few people can see that. So we have to be mindful on valuation. I keep thinking about this, right? When you overpay 80, 90, 100 multiples, chalta hai? No. There are a lot of lessons to be learned. And I'll give you what happened. In this 22-year period, Walmart grew. Walmart grew by 7%, which is much, much higher than US GDP growth. EPS growth of 8% because they do a lot of buybacks. Share price grew 3%. It means technically the fundamentals are good. Since you overpaid, you got the bite. This is a small lesson which I would like definitely write. When we think about a portfolio, how much valuation at a stock level is important, and we are very, very cognizant. The last framework, we are big fans of daily use products. In a high inflationary environment, what happens, right? We think product from a SKU level, because if you're buying a 10 rupee product, right, a 2 rupee Britannia biscuit price rise was not even an notice. It is 20%. At the same, a 10 lakh a car becoming a 12 lakh, right? Does it has impact? Yes or no? It has, right? Because at absolute level, Balaji, you will say it's 2 lakhs. So we are, in our portfolio in Solitaire, we have a very heavy exposure to daily consumed, not only consumers, industry consumption. And maybe I have one small question. What is the best performing stock in US for last 20, 30 years? Maybe any 2 guesses? I'll be happy to take, and then I'll show them. Any from audience? Domino's, good guess. I think it's a fantastic stock. Unilever? I thought someone will talk about Fang. Okay. Huh? Haynes, okay. So, okay, no fans. I think after the crash, otherwise it was easy, right? People keep talking Google, Amazon, fantastic company, no second question. So one such company where we did a big study called 1,000 bagger in US called Monster Beverage. I'm sure the energy drink. So Monster is a listed company and Red Bull is unlisted, right? There are only two players, very big guys. In India, they are dominating, right? So this is a very interesting data. 27 years, Berkshire Hathaway 11%, Monster 35, Microsoft 16, Berkshire 35. So you see any time period, Monster Beverage has won the race, not even by leap of 1 or 2%, by miles. I think Domino's come very close. So these are the companies that have become 1,000 bagger. So the big lesson from here, we have taken two lessons. I would like to share the lesson, not the Monster. We don't own Monster. The two lesson is, Monster had great leadership. They did 30 years the same thing. Sell energy drink, sell energy drink, sell only energy drink. Right? So I said, right, strong leadership matters. And sell small SKU products. Right? 100 rupee, 50 rupee, $1, $2, right? It keeps going on. Fantastic. I think we have imbibed. So we are very heavy on both industrial consumables, which if your factory has to run, you need that product without, you cannot run a factory. We have a lot of exposure, and we do have a lot of FMCG, right? You have seen in my weightage, 15%. So with all the fireworks we use to find, do we get one Monster in India, right? That's my always an ambition to figure out and see it. So where are we seeking value to end? Having shared the philosophy, how we tie to portfolio, how we think about both valuation risk and so on and so forth, I would like to end, where are we seeing value? We are seeing value in a very, very boring growth, very insanely profitable industry, which is none other than, in Bangalore, I don't think it suits extremely well, information technology. And to end, information technology is a growth industry. And I just got some data, which is a 10-year data. The ranking of lot of large IT company has actually gained. See, if it was not a growth industry, the rank should have gone down, right, among the 500 company. But you see a lot of ranks have gone up. So the conclusion is simple, very long term, expectation is low, delivery is high in IT. In a lot of other industry, expectation is always very high. At times they deliver, in most of the times, they give a skip, right? So we are very favorite, I think, last 3-4 months for all the new investors, I'm sure you would have seen, we bought a lot of stocks with 5% yield, with growth improving, right? So I don't think you get a combination with 5% yield, growth improving, low risk, right? These are debt-free, long history, very profitable. In my language, I keep telling about Kuber God. They keep giving you dividends as a trouble. So fantastic industry. We do take a good exposure. To end, for us, long-term success is only two things. Ride the winners. If you have a good winner, keep riding, keep allowing the compounding to take place, and sell losers on the base on fundamental, not only price action. Price do sometimes fall for non-fundamental reason. You can be quiet. But if its fundamental is also deteriorating, it's good to exit, right? So this is the only principle we carry. And the team, I'm sure you will know, we have built a fantastic team in the last 3 years, help of Shyam all. So it's a big of a teamwork rather than individual work, which is what Shyam alluded in the beginning. The proof is finally. So we have compounded capital at 20.9%. I mean, it's a 3.5 years track record pretty well. I think last 1 year is what it's clearly seen, right? Market's been very turbulent, very been volatile. And I think we have done a pretty decent job. My last slide is, we strongly believe, which is what Rashmika started, long risk, lower the risk is equal to long-term sustainable return. We have delivered this performance on 3 years with a lower risk, which clearly demonstrate it's not about taking the high risk. Actually, you take the low risk and low hits. Then you end up compounding the capital. Thanks for the opportunity and looking forward. Any questions? Happy to take. Sir, Mike, I think.
In the framework 4,
yes,
you talked about Walmart, right?
Yes, sir.
So basically, a company can be a growth stock. Eventually, it can become a value stock. Then someone disrupts either the same company or some other company in that sector. Then that becomes a growth stock. You got my point, right?
Yes.
What I'm trying to say. Is that what it means, right?
No, sir, there is nothing called growth stock or a value stock. A stock need a growth, otherwise it becomes a bond. What we are trying to seek is, every stock has to give a free cash, right? So we give cash to buy the stock, correct? Finally, the stock has to give back in terms of free cash flow. So we have to pay at a right price and not like buy blue chip at any price and seek prey. I think at least that's not the way. So that's what my ment is. Walmart is a great company. It was good at a right price and it was wrong investment decision at a wrong price. No, it's growing at 7-8%. In US, the US growth is between 2 to 3. I think it's a fantastic growth stock in US. And in our eyes, I think it's slightly a low growth stock. I don't say a value stock. Hope I answered your questions. Thank you.
You mentioned about IT companies in your chart.
Okay. Yes, sir. Yes, sir. Yes, sir.
Yeah, you mentioned about IT companies in your last slide. So I'm sure everybody has heard about ChatGPT and how ChatGPT can also do coding and testing.
Right.
And with the bulk of the IT companies which are listed in our markets, they are service companies.
Yes.
And the bulk of the jobs in these companies or the people in these companies do coding and testing.
I agree.
So do you see the same growth rates going forward in these companies?
Sir, okay, the broad philosophy on the sector, obviously where we are buying into one of the IT companies servicing aero industry, right? Where actually the aero industry is just coming off the COVID. And finally the management said, because of China is opening up, close to 20 lakh people are going to come into the market. I think that's reflected in all airlines and airfares, right? So there are few companies which doesn't get big impacted. I'm pretty sure it's going to be a new challenge, but that's why we need a good management. When you have a great management and they see a challenge, right, I'm sure they're not going to keep quiet. They will respond. And as an investor, my only job is, as data comes in, right, we take a dispassionate view and take decision rather than in anticipation. These are companies which has gone through all cycle from Y2K and so on and so forth, right? We have seen them. Hope that they will be able to manage any short disruption which can happen. It's part and parcel of every business, and I hope our teams have demonstrated. And in the budget, the entire government is thanking the IT because we are doing a fantastic job. It's a benchmark industry to the country, and I think the valuation turned very attractive, right? As I said, we bought companies with 4-5% dividend yield. So I think we did not pay up for the growth. Hopefully growth comes back. Our shareholders are happy in the long term. Thanks. And any last question?
So one question from YouTube Live.
Yes, sir.
Portfolio activity and opportunity cost is contradictory sometimes. Will you be churning your portfolio if risk and reward is good on valuation by relaxing a bit on the principle of buy and hold strategy?
It's a very interesting question, actually. Right? So what you mean by principle is, when you start a decision, how you think is what buy and hold. But in COVID, I will tell you, we did had a selling of few stocks which we just not even held more than 1 year, rather it was close to. Because the stock shoot up like 400%, 300%. So what you thought in 4-5 years you end up making half the return, you ended up making in a very short time. Yes, there has to be a change. But the whole thinking is, you start the journey as a long term, but if the market rewarding all the 5-year return in let's say 6 months, I think and the risk reward is not favorable, absolutely no, without any questions, the selling has to happen. Because stock cannot hold on. And we have seen last 1 year classic example of implosion of high valued stock, precisely. I think we have done it and we will do it where the forward IRR of 3-4 years is close to negative. I'm sure we will go for a selling.
Thank you.
Thanks for the opportunity. Have a good day. Thank you.
Thank you, sir. Small cap investing has been the highest potential in a growing economy like India. It requires an invest and wait mindset. Conviction needs to sustain for a long period of time. Vriddhi is curated to help you hold your conviction steady and results will follow. The reward is for long term of conviction. To speak about the Vriddhi way, I'd like to invite Mr. Rohit.
Good afternoon, everybody, and I really appreciate. Thank you for coming on a Saturday afternoon and spending time with us. I'd be talking about our small cap offering Vriddhi, and I'll also cover the topic, is it the right time to look at this space more aggressively? So first up, let's understand why could small cap be interesting, right? And I would start with the answer. The answer is outsized returns. Essentially, the construct of that market is that it's a fairly illiquid market, as a result of which a lot of institutional participants don't come in, as a result of which there is not much coverage, and there is a chance for people who have a research mindset, who have a long-term orientation, they could probably have a chance to get outsized returns. And if you see in the last decade, these are some of the names that have been big winners, more than 10x, 20x, 50x, even 100x. We've been lucky to partner with some of them. But the key point here is all these were very small companies, probably less than 1,000 crores, many of them. So there have been opportunities which have been wealth creators here. However, this space is sort of not a uniform space. It's a very vast space, right? So you need to really have some sort of a navigating tool or a framework to go about when you're picking stocks here, right? Here we've just taken one filter, and it's not the only filter that we use. But if you can just take one filter, you can sort of eliminate almost 2/3 of the companies here, right? So we need to have one clear framework to, when you go and pick stocks in this vast field, right? So what is our framework, right? So we, and some of this would be what Balaji or what Niranjan or what even Shyam spoke about. So we focus on companies which operate in very niche areas, but they are market leaders in those areas. So most of the portfolio names would be number 1 or number 2 or number 3 in the areas that they operate in. This could be in India or even globally. So that's a very clear focus. Also, I think most of the portfolio names, we are very clear that we don't want to have a lot of leverage in the portfolio. So most of the names of the portfolio would be debt-free or in fact cash-rich. Now you combine these two characteristics with the fact that these companies are very well run, people who have had a very strong track record of scaling their business, very good track record of capital allocation, and corporate ethics and governance are very high. And you, as a minority shareholder, get a fair treatment with, as being partners with them. So if you combine all these three with the fact that you buy at a price which makes sense, then I think it's a great recipe for good returns. Most of the names that we own in the portfolio are very little research is available. They are under-owned, they are undiscovered, and hence under-researched as well. So very little FII or DII ownership is there in the portfolio, which I think is a great recipe once the story gets discovered and when the company scales up, because you get re-rating as well. Just following up with that, so if you have companies where little research is available, then you have to fold up your sleeves and then sort of do more research, which is what we like to do. So we visit a lot of companies, we meet a lot of companies, we visit their plants, we meet their management, we meet their ex-employees, existing employees, bankers, auditors, competitors, suppliers, distributors, to get an understanding about the company beyond the numbers, right? What happens is we tend to buy companies for 3, 4, 5 years, right? So in between that journey, the stock price can go up and down. So you need to develop your own conviction to be able to not be driven by that stock price. You need to have differential insights. You need to have understanding about the company, their competitive advantage. All that, this process helps us. And this has helped us to unearth a lot of winners. And also it has helped us to avoid a lot of not so good stocks. So this process is something that we swear by. And I think it's not just when you invest in a name, right? It's a continuous process. So you invest in a company and then you continue to do this over a period of time. And you're able to understand the company more intimately. So this is just in terms of what I've just been talking about, right? In terms of our philosophy, that's in action. So almost 2/3 of the name are debt-free market leaders and very little coverage. So that gives you an edge if they are right. Also in terms of growth, majority of the companies have had a very strong FY22 and even H1 FY23 has been very strong. So if you see, more than half of the companies hit all-time high revenues and EBITDA. And we feel that over the next 3-4 years, this trend should continue, notwithstanding the intermediate problem that we are facing because of inflation and everything. Now, I've spoken a bit about how we pick stocks. Now, I think also equally important is how we build portfolios. And I think Niranjan also spoke about it. Balaji also spoke about it. As a house, we have a clear thinking that we will not follow a model portfolio, which means that a client gives us money, we are not going to invest all of it on day one. So we take our time, and we use that time to build a portfolio. For example, this is a live data for a client who started with us in May 21. We took almost 10, 11 months to build this portfolio. So cash was not utilized on day one. How does this help? So one, we slowly respond to the data and we are able to use that data to build conviction. And two, most importantly, volatility, which is inherent in the system, right? I mean, if you're investing in the equity markets, it's part of the system. It's a feature, it's not a bug, as they call it. So that volatility is being used by us by slowly deploying this cash. So we are very clear, and that's how we do it. And it has helped us. So this is the data since we started the scheme in May 21 till Jan of 31, so about 18 or 20 months data. So we have compounded 100 rupees to 132, whereas the index has compounded 112. This is still, I would say, it's a short-term data. It's, as I said, we invest for 3, 4, 5 years. But what I want to focus on is the fact that we are focused more on the process. The outcome would sort of take care of itself over this period of time. But what I would like to mention here is, if you talk about the last 1 year, which has been a turbulent year, I think Ihab mentioned about this point in his presentation, which I think was a brilliant point, that during a down market, the alpha created is much more valuable. While it may not be intuitive to investors, all of us want to make money, but every rupee saved in a down market is actually going to give you much more when the markets revive. So we have seen the portfolios being very resilient. We've fallen by about 3.5%, whereas the market has fallen by about 15%. But we feel that the portfolio, despite being in a very small kind of market cap companies, this has been a very resilient portfolio. And as I talked about some of the things that we do that contributes to this resilience. Overall, I think the space, as I mentioned, is very vast. So you need to have a framework to control risk. And our overall focus is to really be risk averse. We are not trying to hit sixes. We are trying to not lose our wicket. That's what our overall philosophy as a house is. And that's also what we follow even in Vriddhi. That's why we don't want over leverage. That's why we don't want to partner with faulty corporate governance companies, even though they may look very good in the short term. So our overall conviction sort of is built on this fact that we have been able to generate very good returns over the last decade following this risk control framework, and we will continue to do that over the next foreseeable future as well. And one point I would like to highlight here is that generally small cap is termed as more volatile, and which is the case. However, we believe that if you're able to develop that conviction in a name, right, then volatility is not necessarily a risk, right? So if you are able to develop conviction in your process, in your portfolio names, then that is a great opportunity for you to use that volatility as a friend. So, and this conviction helps you to look beyond the immediate 2, 3, 4 quarters. Market participants are generally looking at 3, 4 quarters. All of us talk long term, but it's really, everybody looks at the next 3, 4 quarters. If you look at our portfolio, our churn is 0.05, right? So essentially, it's like extremely long term. So we've only, so why I'm talking about this is extremely important to understand why we are doing what we are doing. Over the next 3, 4 quarters, everybody is chasing that name, so you really can't develop any differential insights, right? Also, for you to let compounding do its magic, you have to give it time, right? So we try to look at the next 4, 5, 6 quarters and beyond, so that we are able to hold that name. And we, as I said, we build our positions gradually, so it helps us. These are some of the names that we have picked in the past and that have helped us in generating returns. I'll probably speak about one specifically, and just which encapsulates the entire thinking process that we have talked about. So this is one company called TD Power System. It's based out of Bangalore. It's a market leader in what it does, and we for about 3 years. So the entire journey, if you see, it's been almost 7, 8 years of close tracking of this business. As I said, it's a market leader, and and it had cash in its book, excess cash in its book. We bought this company at about 300 crores market cap. Now, if you see, the business was not doing well over the last, probably between 15 and 17, and started to do well between 18 and 19. That was not clearly reflected in the stock price. The stock price was flat for the 2 years. We started with a 2% position, so slow and staggered buying, and then kept on adding to our position. And then we had COVID, where the stock price fell by 55%. So you had about 2.5 years of negative returns, first no returns and then negative returns, but we kept on adding. Why would that be? Because we were intimately researching the company, we were closely following the company, and we understood what the company was trying to do. From a single product company, single geography company, it was moving to a multi-product, multi-geography company. So this part, so eventually from 2%, we took it to 10, 11% at cost, our allocation. So we kept on buying as market sort of didn't agree to our thesis. Eventually, obviously, we were rewarded. But what I wanted to share in the previous slide was that it's again that conviction which helped us to look beyond the 2 years or 2.5 years where money was not being made. So that's what I wanted to sort of encapsulate in that example, and we have still not sold any share. So we have held it for about 5 years and we are still holding it. While I've spoken a lot about what we do, I think equally important is what we don't do. So these are some of the things which we feel are suboptimal if you are trying to create long-term wealth in the markets, and we try to avoid that because that's the best way to avoid it. Now I'll come to the question which is oft asked from me, that is it the right time? Abhi lene ka hai ki nahi lene ka? So I'll just share a few indicators and talk a bit more about probably what we feel. So if you look at, this is the first indicator. So small cap is down about 18% from its peak, whereas all the other indices are broadly even. So that is one thing to think about. So it's been not in a great shape, so probably it's the right time. That's one data point. This is an interesting chart. So the black line that you see, that's the search terms for the term multi-bagger, which is usually associated with small caps, right? So it is notoriously peaks when the market also peaks. So probably it's very, very far away from its peak. So again, probably a very good time to start looking at this space. Third, if you look at, this is a 2-decade time series data. This is basically Nifty small cap index by Nifty 50, which is the large cap index. Usually it bottoms out around 0.4, 0.5. We are close to 0.5. Now again, big caveat, I'm not saying we are bottomed out or we will not go down. I don't know. But what we are trying to see from all this is, are we in a very red hot zone from a valuation standpoint, or are we close to investing zone? We feel we are very close to the investing zone and very comfortable with the valuations. Now, if you add all this to what a lot of people have talked about, and I won't go too much into this, but a lot of the things are going good for our country, and we must be very happy and fortunate about it. And I think we are on a very strong wicket. And I think a lot of things will help the companies that we want to invest in, directly or indirectly. So the story of India is getting much, much stronger. So if you ask me, it's a great time to look at from a 3 to 5 year view. Obviously, with the view that there could be much more volatility in between, but I think it's a great time to start or add to whatever you have in your portfolio. Just to sum up, so I think the space that we operate, I think, is extremely exciting, and that gives us the kick to do what we do. Our portfolio, I feel, is extremely resilient and has very strong names, undiscovered but very, very good businesses. And that quality has been demonstrated in the last 1.5 years of tough market period, where you had a war, you had a lot of inflation and a lot of other things, but the portfolios have been resilient. And on top of it, we feel that the growth has been robust and will continue to be robust. So it will be a great opportunity if valuations correct, then it could be a great opportunity to add those names. And as the story of India gets stronger, there will be much more interesting businesses which will scale over a period of time, which will get added to the portfolio. So yeah, I think it's a great time to be in India and to invest in India. So yeah, that's all I had to share. Thank you, and I'll be happy to take any questions.
Hello. Firstly, thank you for the presentation, very insightful. Given the environment that you operate in, especially around the small cap segment, I suspect your biggest challenge will be, like you listed, around risk management, especially around things like corporate governance, etc. I'd just be interested to hear your thoughts around how do you go about establishing a framework for something like corporate governance, because I suspect that would be one of your biggest challenges while evaluating an investment philosophy. So if you could shed some light on that, that would be helpful. Thank you.
Right. That's a great question, actually, and that's something that we always keep on stressing within our own team and discussing about it. So I think first part is just doing like a deep study of whatever is available in the public filings. I think a lot of the times, I would say more than 80-90% of the time, public filings are a great a lot of breadcrumbs are left, so you have to find those breadcrumbs. And public filings don't necessarily hide a lot of things, they reveal a lot of things. So I think that's the first step. Then I think also talking to a lot of people within the ecosystem, and also given we have people in the team, and given we have an extended network now, we've been investing in the markets for more than 12 years, Shyam's experience more than 3 decades. You know how people have behaved over cycles, promoters have behaved over cycles. So you get that understanding as well. So if you combine all these things, you'll never be able to clearly say that, that this is black or white, because everything is not that. But you will be able to avoid a lot of pitfalls. So I think just by being very diligent in our forensic, by reading the filings properly, by reading a lot of filings, not just the last 3 years or 5 years, but going back as probably 10, 15 years, I think that itself will give you a lot of insights and information about how the people have behaved over cycles.
Excuse me. Here. Thanks for your presentation. You mentioned that you have built a client portfolio over a period of 11 months. So, but we have seen many a time the small cap cycle as a company sectors change over a period of 2 to 3 quarters. Okay. So when you are building a client portfolio, how you manage that volatility? Because after on 12th month, you might see that whatever alpha it has generated for the last 1 year, 2 years, it has gone completely. The cycle has changed, and nowadays we are finding cycles are very short. Okay, over a period of 2 quarters, completely changing. People are moving to other side, and that is the trend. Please, can you please elaborate? Thank you.
So I think in markets you get what you want. So in the sense that there is always a space for a very fast churn. As you said, there are companies where 1-2 quarters data is very good, and then suddenly the stock has gone up 50-60%. But maybe that you can do in an individual way, because when you are managing a large corpus, getting in and getting out itself is not so easy. So we are looking at, and hence the kind of companies we want also needs to do much better beyond 1-2 quarters, right? So we are looking at those companies which will sustainably do well over next 3, 4, 5 years. So there has to be something special which will enable them to do that performance, not just in 1-2 quarters, but over the next 16, 20, 24 quarters. So we would avoid these names, and we would be patient, because I think, I mean, and that was just one example. There are many such examples where we built positions over a period of time, and the stock price was contrary to what we thought in terms of what the underlying business performance is. Even if you see TD Power, the business has doubled in 4-5 years. The profits have gone from 10-12 crore EBITDA to 100 crore EBITDA, right? But the stock has just done well in the last 18 months, right? So this underlying business movement is what we focus on, and that's what we are more interested on, which we feel that eventually the stock price will correlate.
Hello. I have a question here.
Yeah.
In your slides, you mentioned that you are not in favor of momentum stocks. I can give you many examples where momentum stocks have given you a lot of returns. Examples, banking stocks. Bank of Baroda moved from 70 to 163, 191 in a short time. Karnataka Bank, Punjab National Bank. So why are not interested in momentum stocks?
So I think it's the same question that, if you chase momentum, then you don't know, one, you don't know if the performance is sustainable or not, right? You are just chasing the price in a way. There are two things. One is a business momentum, and then there is a price momentum. We definitely want business momentum behind our stocks. And that business momentum should not be only 1 quarter or 2 quarters. It has to be sustainable. Suddenly some commodity price has gone down and hence there is a great profit and you report very good numbers in 1 quarter. But if your business is not good, then that profitability will be taken away because the markets are efficient. So we are focusing on business momentum, not price momentum. So that's one thing that I would say. And we are looking at next, not just 2 quarters or 3 quarters. We are, as I said, we are looking at least 16, 20 quarters.
But there is a huge opportunity loss. Because you say
no,
you're going to wait for 2 quarters, 3 quarters. You have lost a big opportunity of investing and getting the returns.
I would say that so one is obviously everything looks great. 2 quarters back, something was 100 and now it's at 150. It looks great. But how much of it was executable? How much of that was really possible to really buy and sell? At least as an institution or managing public money, I think a lot of it goes in even in impact cost. So I really don't know. Money is actually made over a period of time. And if you really try to take a lot of decisions, then actually the probability of you getting right actually goes down. Even the bestest of investors are right only half of the time. So in that sense, the more decisions you take, you are lowering your probability. Can you, yeah, sorry.
You spoke about public filing that is available for corporate governance, right? So just one thing, since you told about the TD Power Systems also,
right.
I'm not sure how much data will be available, but my question is when you identify a company, because it's a small company, you want to invest, you also get in touch with the management, or it is only about the circle of...
No, we do try and meet the companies because it just does help you to understand the journey of an entrepreneur, how they have scaled a business. So many, I would say, sometimes you don't need to because the business itself is so clean. You can understand accounts, you can understand the books very well, but we'd still like to go and meet them because it helps you to understand the journey of an entrepreneur, right? Because ultimately, he's also running a business, he or she is also running a business, and he or she will also face a lot of challenges at some point of time. So how does the team think? So all that is important. So we would definitely want to meet a company. I would say we meet a lot of businesses over which we invest or we don't invest, because that's how we also learn about so many companies.
The reason I asked is a small company only at some point of time becomes a mid or a large, right? So unless you capture that at the very early stage, it is possible only with discussion, right?
Right.
You won't know, you may know the company name, stock may perform for 1 year, 2 years,
Correct.
3 years.
I agree with you. You have to understand what is so special about this company, which they may not be writing in their annual reports. So you have to go prepared and ask the right questions. And we've seen that if you go prepared and ask the right questions, the management also gives you a lot of good answers, and they also respect that somebody has come and is really genuinely interested in understanding the company.
You mentioned about business momentum.
Yeah.
You mentioned about business momentum. So what is the criteria of exiting a stock in your portfolio? And what is the maximum allocation you put in a single stock at any given point of time?
So exiting is essentially largely on valuations, and also the fact that you try and see in terms of, you try and assess what any business operates in there would be some constraints for its growth or for it to gain market share or to sort of grow its top line and bottom line. In the context of what valuations they are, we tend to see that and then decide an exit or not. There have been cases where we've exited because of high valuations, and there have been cases where we have still invested despite slightly higher valuation, because we feel a business can still scale up from, let's say, 300-400 crores to 1,000-1,500 crores. That's what we believe. Whether we are right or wrong, that only time will tell. But broadly, we take these two things and and then marry these two. Like, can the business scale, and will the current valuation justify the scale up in the business? And in terms of your second question, as I said, we scale up slowly. So we are okay with going up to 10, 12%, in very extreme cases 15% as well, at cost in terms of our allocation. So TD was one example where we went up to 12% at cost, because we were very convinced what the management was doing, what the opportunity was, and the valuations were just too mouth-watering. So we did that. But it will very rarely that it will be first time we'll put in 10%. Very rarely. We will do it sometimes, but rarely. I think we will be out of time now. I'm here and the team is here, so we'll be happy to take any questions later. Thank you.
Before we close, all of y'all would have received a digital feedback form to your phone number as well as your email ID. Just request you all to take 2 minutes to fill that out. And I'd just like to invite Mr. Shyam to share the closing remarks.
Firstly, I'd like to thank all of you for coming here today. It's been quite extraordinary for us to have so many of you come here and listen to our work. I'd like to thank the AMCs, DSP, ICICI and HDFC for their support in helping us curate this event and its content. I'd like to thank all my colleagues who have put in a lot of effort in making this event a success. In fact, my role is very minimal. It's entirely to their credit that they've managed to, curate this event. I'd also like to thank the hotel for all their support and the crew who have done a fantastic job with this event. Before you close this session, I'd like to tell you that after lunch, we are having a 1-hour personal finance session, fireside chat with PVS, Subramanyam, who's here. I've created a good list of questions to grill him with, so it's going to be 1 hour, and it's going to be a very, very interesting session. So I would request all of you to enjoy your lunch, settle down with your dessert, and listen to the wisdom of Subra. There's nothing to beat that. And before we close, I just want to make an announcement about a product which we have been quietly curating for the last 2 years. Some of you may have heard the beta name of that brand. Today we are going to unravel the brand. What is this about? It's about a need which we are trying to address in the ultra HNI and the family office space, where they want to put money in very large companies which are very safe to own and still make good returns. What is happening is that though people buy these great quality companies, today most of these people are sitting on losses. In my view, this was strictly avoidable, and there is a better way of doing it, and we were quietly experimenting this better way. And we had given a brand for that product, and it's time to actually put the product in perspective. This is a product which I believe will go a long way, and it will probably be a better alternative to most blue chip investing options in the country. Friends, I'm very happy to present to you True Blue, our blue chip brand, which will be very, very exciting from what it does and also from what it can do for you and how it can do it better. True Blue is our offering, and I would definitely exhort all of you to know more about this product, because it's not only curated in a way which will deliver value, it's also priced to perfection. Thank you very much. Join us for lunch and join us for the dessert session with Subra. Thank you very much.
இல்லாட்டா அது கொஞ்சம் ஆங்கிள் மேலே.
Start. Friends, good afternoon. I never miss an opportunity with Subra to ask him questions on personal finance, because each conversation creates new layers. Every time we discuss this subject, something new comes out. So when we had this event, he said he will join us in the event. And my immediate greed or spike of greed was I should get something from him, something which we can learn from. Experience is such a great teacher. It's the most undervalued asset, because the amount of experience a person has mostly translates into wisdom, and that is something which we don't realize the value of for a very long time. So in that sense, every conversation brings out something new, a facet new, and before the conversation also you prepare for the conversation by creating questions which will be useful to others. So two ways. One, I get answers for my questions. Another way is that I take what I think will be questions in people's minds and put it before him. So today we are going to have some questions which I have put together, and you can also ask your questions after I complete my questions, and those who are on YouTube can post your questions and we'll try to answer them or get Subra to answer them. Let's go to the first question. If I am just starting work, what should be my first wealth goal? Should it be a house or owning $1 million?
Thanks, Shyam. Thanks for the opportunity. And yeah, again, see, this is the issue is the goal has to come from the client, right? The client has to say what are his goals. We are only going to make sure that there is enough money to do it. Because what happens when you start getting into the client's goals, you start passing value judgments, and largely you find goals are not driven by the kid. It is driven by the kid's father, mother, in-laws, wife, everybody. So you say, oh, you have to buy a house, you have to buy a car and things like that. That kid might want to buy a 20 lakh rupee motorbike and go to the Himalayas. But he's then pulled down and said, no, you have to buy a house, you have to do this, you have to get married, and goals are. So the first question to ask is, who should set the goals? Should the boy or the girl set the goals? Should society set the goals? Or should the financial planner set the goals? That question has to be answered first. Then therefore goals will differ. So somebody who's been brought up in an orphanage is very insecure, will want to buy a house. Then it's not a question of which is the most efficient thing to do. He will want a house or she will want a house from where they can't be thrown out. That insecurity will be there. But a kid whose father has 2 houses, mother has 2 houses, grandfather has 2 houses, he's the only grandchild, he knows he's got 5 houses, he might have a completely different goal. So each person has to decide what his goal should be. But if you're asking me from an efficiency point of view, it has to be money, because it can keep changing. So don't lock yourself into a house at the age of 24, because in your life you may have a job in Dubai, Singapore, Baroda, Bombay, and back to Chennai. Where all will you buy a house?
So your advice would be from, let's say somebody starts working at 22, 23 to about 35, accumulate money, grow money. That is your primary advice.
Yeah, grow your money. After that you decide what you want to do.
Okay, that's straightforward. Now to the next one. A lot of people do very well today. We are living in a city where ESOPs is the order of the day. A lot of companies get sold, putting a lot of money in people's hands. You have rounds within secondary rounds. You have share buybacks which put money in the hands of employees. So we have a generation of high earners. How should this generation of high earners prioritize between spending and saving? Should I live it up now that I am doing so well, or should I become like my father
Okay? Because we all grow up thinking that our parents probably are not the best managers of money. And then when we get the opportunity, our children start thinking like that. So how should this generation of high earners prioritize between spending and saving?
See, if children have not seen financial insecurity in their parents, they will be big spenders. You cannot tell them, oh, I went to school with a chappal, I did not have shoes. He is going to buy a 16,000 rupee shoes and not feel guilty about it. Because he sees his father is doing that. So his father takes him to Disneyland, his father takes him to a 5-star hotel for lunch or dinner. Why is the kid going to look for the cheapest Hawaii chappal, where can I buy? He will not do that. Your kid will be your kid.
That kid is not a relaxo customer.
He is not a relaxo customer and he's son of a rich man. That's your problem. So he will think like a rich man. He will not think. He will go out with his friends and eat in a Japanese restaurant and pay 10,000 rupees. I can't spend 5,000 rupees on a meal. My daughter can. I cannot stop her. So you teach them right when they're young. You take all their dolls and say, for all this we have paid a price, but these 5 dolls, you have used it. So you have been able to derive value out of this. When you teach those things and you show them cheap markets, so they don't say, oh, only 500 for a earring. You take her to a place where it is available for 75 rupees.
This you are saying how you prepare your younger generation for the future.
Correct.
But we have generation of people today who are earning high, who are high earners, who didn't have this opportunity when they were young. See, it is them that I am speaking for. See, there are people today who are in their 20s or 30s who will be probably having more money than their parents, right? Much more actually, maybe twice more or thrice more, right? And it is their achievement. Let's not take away the credit. These high achievers are high earners. Not only they have this money, they are also earning very high salary monthly, right? If you are from that community and you are the first who is seeing this kind of money in your family, should you be, giving your family that comfort and luxury by spending, or should you be now practicing very high saving and saying that no, future is going to be bad or something like that?
Very difficult.
Or past was very bad.
Very difficult to tell those kids, look, future is going to be bad. They can't see the future as bad. So they will spend money, they will have a good life, and when they go into trouble, they may then realize, but today to tell them, like, I have one girl who tells her father says, don't go by taxi. So she told her father, if I ask you to go by taxi, will you go? He said no. So don't ask me to go by bus. I'll go by taxi, you go by bus. That's a fact, right? That kid is not going to behave like how her father behaved. So it's easy for us to say this is what they should do, and they're saying, this old man is going to die, giving all his money to me. Why is he bothered?
Which is where the question again comes. They still need to be taught to prioritize between spending and saving. How do you do that?
You can do that only when they believe that they have to be taught. They don't believe, they think you don't know.
So you're saying,
they think they want to teach you how to spend.
So you're saying don't teach them to prioritize,
You can't.
keep quiet.
Teach them how to prioritize. What they should prioritize is their call.
Okay, so we keep quiet. Right?
Yeah.
This is very important. When I am doing financially better than I expect to, what should I tell myself? This is my question.
No, this is a very good question. You have to first be thankful. Because if you are in this room, you are in the top 1% of this country, just steel your heart, make it very strong, you will pay more and more taxes as time goes by. Fact of life. Do it happily, don't cry, because anyway you're going to pay the tax. Every time I pay the tax, I keep wondering, I don't give my wife so much in a year, but every quarter I'm giving so much to Mr. Modi. We don't have a choice. If you are rich in this country, you will pay more tax. So first, we are thankful to be born in the 1960s. I'm thankful that I was brought up in Gujarati area rather than a Tamilian area. Therefore, I went into equities. So first, we have to be grateful. We are lucky. Right time, right place, good companies. You may not like an Ambani or an Adani, but they made money for me. I'm thankful to them. I'm thankful to Chidambaram for making dividends tax-free, long-term capital. We all made money because of all that, so I have no complaint. So I think you should be grateful, and you should also tell yourself that you're going to live till the age of 102. Longevity is a risk. So make sure you have adequate money for the rest of your life.
So your recommendation is 2G, be grateful and generous.
You have to be, because you have no choice. You can cry and pay your advance tax or laugh and pay your advance tax. But you have to still pay your advance tax. So might as well accept it and pay.
Now to the fourth question. What could motivate someone to understand the value of a life or health insurance policy before a crisis actually happens? See, a lot of families have seen so much pain. And I noticed that the most conservative people, the people who have always thought about their family, about the next generation, didn't value their own life properly. The human life value of the person is not reflected in the insurance. The person is gone, right? Another case, didn't take enough health insurance, and COVID, 25-30 lakhs. We have common friends who have had this problem. Like,
true.
What could motivate someone to understand, how can we make society understand the value of a life or a health insurance policy before a crisis actually happens? Because this is very, very important today.
So 4,000 years ago in Mahabharata, the Yaksh comes and asks Yudhishthir this question, what do you think, what is the most surprising thing in the world? So he says, man attends a funeral thinking he is permanent. He is just tomorrow's dead body. But who will tell him that? It's very difficult, because retirement, health and death are very depressing topics. They don't want to hear about it.
But should we talk more about it so that people realize?
Actually, COVID has enough stories. I think you and I should be making more videos on this, putting it and making sure people spread it.
Yeah.
Because, and somehow we think it will happen to my neighbor, not to me. But when it hits, I have a very simple thing. Suppose God comes and grants you, whenever you meet, you know when this person is going to die or is going to get cancer or something like this. God gives you this gift. And God also tells you, you cannot tell it to him. What is the first thing that you will tell him? You will tell him, take health insurance and take life insurance, right? Since we do not know when what is going to happen, make sure you have adequate health insurance, critical illness insurance and life insurance. Your family has to go on. If your daughter's 4th birthday was in a 5-star hotel, the 5th birthday has to be in a 5-star hotel. She has lost one parent to death. She cannot lose the other parent to full-time work. Make sure your family has adequate money for the next 15 years. By the time they would figure what to do. Your father, her father, her father-in-law, her brother-in-law should not decide where she should live. And I'm just being general neutral. Assuming both are earning equally, you still need insurance. Don't fool yourself into believing that cost is quite low. The cost of peace of mind by taking insurance, the reward of peace of mind by taking insurance is very high. People should realize this.
When I reached a financial goal that I set for myself, what should I do next? Let's say we decide that becoming a millionaire in dollars terms, 8 crores is a target. I have reached that. What should I do next? Because a lot of people, the problem is one of plenty, not one of paucity. So when you have reached that place where you want to reach, people become aimless. How do you purpose them? What is the way in which somebody can tell himself something sensible and be focused on what he can do next?
I don't know. I've always found that I have enjoyed my experiences more than the things. When did I buy last phone or car does not give me so much pleasure, but it gives me pleasure that with my whole family I went on this trip and things like that. So reprioritize, go out with your friends, relatives, cousins, do all that and then see where you are, what you want to do. If it means you want to retire, retire, but don't retire without having a hobby. Don't retire at 45, die at 102, next 50 years you don't know what to do. So I think if you have met your goals, ask your wife what to do next. She will have an answer.
Okay, ask your wife. That is the answer. Okay, this is the era where we have been told that investing is easy, anybody can do it, anybody can become a trader, all you need to do is trade and show your screenshots. So DIY era is what we are living in. How do I decide which is better for me, DIY or professional management? How do I make this decision? I might have made some money, I might have lost some money. My friend says that he's still doing well. He says he bought Adani yesterday morning and sold it in the evening. God knows whether it's true. But these stories are all coming to me. So how do I decide for myself which is right, whether I should be DIY or I should go to professional? I have to make this decision. Everybody has to make this decision.
Yeah,
and they have the right to choice.
Yeah, it's like I keep saying, this is like, suppose you like playing cricket. Monday morning, 9 o'clock, you're still in your office. So Saturday, Sunday, you play cricket. Maybe Saturday, you play cricket. That is 1/6 of your life or 1/7 of your life, you are playing cricket. So take a small portion of your money and do a DIY. Other money, you give it to a professional. After 3 years, 5 years, if you're doing better than the professional, apply for a job in a mutual fund. If the professional is doing well, then give it to the professional. It's so simple. No, you judge on basis of merit. And I have this very simple question to ask. If I tell you, in this hotel, idli is available, you go and eat, right? You don't go to Google and search cheapest idli, where is it available? You don't do that. Why do you think in fund management you go to the cheapest and you will get the best? You won't. Why will a good fund manager come cheap? Why should he? He doesn't need your money. So it will be expensive, it will be worthwhile. So after expenses, if you are outperforming the fund manager, do it yourself. Do for other funds, start your own AMC, or take, if you don't have the guts, apply for a job.
As a DIY investor, what do I owe myself?
Yeah, this is a very good question. So, first of all, personal finance is nothing personal. There is nothing about finance. Okay, let me just put it this way. When I earn money, I have a wife, I have 2 children, I owe it to them that I be responsible with my money. I'm assuming for a minute my wife is not working. So I owe them a standard of living. I owe them a reasonably well managed portfolio. I cannot mess it up and say, oh, my wife doesn't understand. That's not the answer. The answer is, are you accountable to your wife and children, maybe your parents, about how you manage the money? Because what you're earning is only maybe 30%. That has to be grown. Are you being fair? If this money were to be given to a fund manager or you were to do it yourself, are you being fair to these people? Because you're reporting to them. Your wife has given up her career for you. Your children are dependent on you. Their education depends on you. You cannot screw up and say, I put all the money in Adani and it's gone. You can't be stupid with your money. You can be stupid with your money only as long as you're a bachelor. After that, you're committed to your family. So make sure that you are managing it well, and far more important, make sure that the documentation is proper, make sure you made a will, you made a living will, make sure about all that. Believe me, nobody can do all this alone. You need somebody to tell you you're overdoing equity, you should put money in debt, you should buy gold, asset allocation, documentation. Have I made my will? Have I updated my will? Have I kept it in a place where my family can act? That whole thing is money management, not just deciding whether to buy a Hindustan Unilever or Asian Paints. That is easy. That is last 5 minutes of your life. 95% of money management is dull and boring. Nobody wants to do it. You want one boy or a girl who will do all that for you. It's too boring. Who wants to spend a Saturday, Sunday doing reviews here? If a boy is willing to do it or a girl is willing to do it, let them do it. So I think it's boring, therefore you should outsource it.
So you owe yourself accountability.
You owe your family accountability. To yourself, you will say, oh, it's okay. I lost money, I'll make it up. You have to be able to stand up to your wife and family and say, this money I earned, this money I lost, this I earned more. That you should have the ability to do.
Again, I'm going back to home buying, because young couples have this difference of opinion. I see that all the time when I have a couple come up and discuss what they should do next. One person has an idea of how they should live. Another person has a diametrically opposite idea. But that idea finds maximum difference when it involves buying a home. So for young couples, when should buying a home become a priority? People marry at 27, let's say, 25, 27. When should they think of buying a home according to you?
I'm happy you brought up this question because boys tell me we can't get married unless we have a house.
That's a South Indian problem, but not a national problem or a global problem.
Global problem. Sir, we don't have. So boys buy a house because otherwise they can't get married. Women think that, I think you should not buy a house today simply because you don't know where your next job is going to be. So if you're in Bangalore, then in Baroda, and then in Gurgaon, and then in Bombay, then Singapore, Dubai, how will you end up buying in all the places? You cannot afford to pay EMI in one place and rent in another place, then there's no money left for you to live. So based on all that, you have to buy a house. But one good advantage is father and father-in-law both will say, I will give you 1 crore, you buy a house. So go and take 1 crore from each one of them and buy a house for 2.5 crores. That's okay. Don't put your money in a house.
So when
put your father's money.
So when parents give you money, buying a home should become a priority. That's your advice.
Yeah, I asked one young girl, 23-year-old, who should pay for the wedding. And she said, wedding costs are only 50,000 rupees. Beyond that, it is tamasha. Whoever wants a tamasha should pay. If my father wants a tamasha, he should pay. If I want a tamasha, I should pay. So I think that should be very clear. I need a house to live. If my father loves me so much, he should buy the house, give it to me, I'll pay him rent. Don't ask me to put my money because that's not my priority.
Your tamasha analogy is very useful to me. I have 3 kids, I will tell it when they want to get married. Sorry. How should an employee prepare for self-employment or entrepreneurship? This is a very, very important question today. A lot of people want to start something on their own. That number of people wanting to do this is now increasing a lot. So how should an employee prepare for either being on his own as self-employed or to become an entrepreneur where he's going to employ a lot of people?
Between becoming a self-employed, entrepreneurship, retirement, it's all more or less the same thing in the sense financially. So the question is it a pull or a push? Is some very attractive opportunity pulling you or hatred for your boss is pushing you? If hatred for your boss is pushing you to become an entrepreneur, you will fail because you're not going there positively. Here you will go more positively saying, okay, I have this business opportunity, so I should start doing it, and only after it is, I don't need to leave my job on day one. I can do both, and then once it is successful, I should leave. Also, it should depend on your house. So let's say my name is Subra, and I start a business, and I fail, and if my mother tells the whole world Subra failed, I should not do business. If my mother says Subra's cloth business failed, now he is going to do paper business, which means my house associates entrepreneurship different from me and say that success and my son is not a failure, there you should do. So in 99% of South Indian families, you should not do business.
No, but if I want to do, how do I prepare? Tell me about that.
You have to prepare everybody around you.
Okay, prepare others.
Saying, be ready, I might fail. Because the probability of succeeding in business, see there are two things. One is being in business, one is being in the profession. You want to leave your job and start a CA practice, that is less risk. But if you want to get into manufacturing or making an app which may or may not succeed or things like that, the risk is more.
So how should I financially prepare my family?
So financially, how you have to prepare your family is to say, whatever we do, the next 10 years expenses, standard of living will be maintained. I'm taking a risk only above that. By the time if your child is 17, 18, you say, okay, by the time the child will start earning and things like that, at that stage I can take risk. Or let's say the wife is earning very well, therefore the husband can take some risk. Don't take full risk and say I'll start off on my own because the chances of succeeding is pretty low.
What about the emotional preparation? How do I prepare my family? Financially, you said I'll keep 10 years money or 5 years money, whatever, and then you do that, everything is fine. What about the emotional preparation?
So emotionally, go and buy a nice big car and everything and say, look, we are not so badly off. I can still maintain all this, and then start your own business. And make sure you don't need money from the business for 7-8 years. So I have this well funded. And then also change the definition of what is success inside the house. Because in employment, what is success could be very different from what is success in entrepreneurship. And entrepreneurship is dull and boring.
Can you speak a little bit more on this definition of success inside the house, inside the house?
Yeah, change the definition of what is success, because your success can't be the neighbor going to Egypt, so we have to go to Vietnam. That is not success, because in business, your success would be your balance sheet net worth going up, you not having to borrow money from outside, and those would be the yardstick for success, not how you spend. So teach your children to read balance sheets, profit and loss accounts, etc., and say success means this growing is success, not what we show off as assets. Like what Warren Buffett says, inner scorecard and outer scorecard. Teach your family about inner scorecard and say, I'm doing all this for you, and therefore we are going to do well. That changing the definition. And see how much is the support. If your mother, father, wife, father-in-law, everybody is against your business, rest assured your business will fail.
But I'm going to take you on this, I'm doing this for you thing. It doesn't work.
No, I am doing this for you in the sense you have to be part of this. Because if you
I will tell you, today I'm sure many will kind of resonate with what I'm saying. Today you go and tell your teenage kids that, I'm working so hard only for you, or to, so that you can have a very good life, or, you can have this great lifestyle or future. They don't agree. They think you're doing it for yourself. They will not, immediately you will hear a reaction saying that, no, you are doing it for yourself, you are using us as an excuse. Where did I ask anything from you? I can take care of myself. The statement comes. Later it's a different story whether they take care or not.
No, I think it should start by teaching children about money right from the age of 3 or 4. Teach them that nothing comes free.
So if you want to become an entrepreneur, later you should make them appreciate entrepreneurship from childhood.
Not just entrepreneurship, about money, and say, we are not capable of doing all the work, therefore we have this servant, therefore she comes, we have to be thankful to her or him, and give that salary handout. I have friends who give that salary handout in cash by the kid, saying thank you uncle, so that they have to understand that everything comes with money, and in the ATM money comes because mummy and daddy are working hard for it. It does not come automatically that I put my card and money comes. So kids can be taught this from the age of 3 or 4, whether you are in a profession. Please understand one thing, all of you, your children are going to be taught about money only by you. Your school, office, college, nobody is there to teach. Many CEOs who have told me, I wish I had met you 25 years back, do not do this training for their own employees, right? So, corporate India is not here to teach you about money. In fact, they are here to not teach you about money. They want to encourage you to spend more so that you can get into a debt trap and you can borrow more. So,
but so does the finance minister.
Everybody. If you see the shift from old regime to new regime, is to say, boss, don't spend, don't save, don't invest, go and spend. So we are going the American way. So we will go. So you cannot stop your prime minister from doing that. You can stop yourself from doing that. Teach your children money. That's very important. So if you started an SIP for your kid when the kid was 11, you were 11 years late. And if your name is Parekh, it's even worse. You're 12 years late.
This is a very interesting question. How should an investor deal with success in equity investing?
Gratitude. Back to gratitude. Just bloody luck. You realize you made money in equities with just bloody luck. To know whether to trust Deepak Parekh or Kapil Mehra or Dhirubhai Ambani was luck. I could have sold my Reliance and the HDFC and bought Orke, I would have been ruined. I just got lucky. So same thing is true. Anybody who is successful in equity investing has had a tremendous amount of luck. But after getting it, you keep saying, oh, I always knew Mr. Deepak Parekh was great. I did not know it in 1980. It took me 15 years to find out he's great. After that, I didn't sell HDFC Limited or HDFC Bank, right? So the amount of luck, if you remove, you realize you're just lucky that you were there in the right time, right place. Markets boomed. Like Naren said, Subra, I and all were sitting on a round-shaped object in 2002. Only in 2007, we found out it was a rocket, right? So that's luck. So be thankful for what you have. keep on putting into less volatile asset class, because with age you may not be able to manage it well. So you say, okay, at the age of 70, I want X amount of money lying in G-Secs and things like that, very safe, solid, and then I will play around with the extra money. So first, and teach this to your children, because if your children are not going to do it, index fund works. But if your children are interested, teach them how to do equity investing.
So the first thing you said was be thankful. The second thing you said is, learn to deal with it. In this learning to deal with success, that's the question I've asked. You're dealing with success at multiple levels. One is you deal with it emotionally, which is what you feel thankful and all that. And then you tell your family about it, you externalize what you're thinking, communication, all that is fine. What about dealing with money?
Yeah, as long as you learn to live on your dividends, you can be sure that your principal is safe. Because in this market, things can go awry. One of the richest men in the world, Cyrus Mistry, late Mr. Cyrus Mistry, was on the verge of default. That day I decided never ever borrow for anything. If you borrow, you could be in trouble. At some stage, imagine Cyrus Mistry having to call a fund manager and say, don't put the check today. That kind of pain is there in borrowing. Borrowing can be extremely painful. So you have to have the resilience of a Adani or an Ambani to be able to borrow, use, earn, right? So make them understand that, I just said this in the morning, Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in seconds. You can take 30 years, 40 years to build your wealth and lose it like this. Early part of Russia, they just abolished the stock exchange. Can you imagine what will happen to all of us? Kal se sab stock exchange ban.
It happened now, just now. During Ukraine war, it happened again. We talk about long back. It happened again.
So be ready for such dramatic things which can happen. It's horrible sounding, but we are never ever prepared for the next crisis. We are all prepared for COVID. But next time what happens could be very different.
I'm going to ask you a corollary to the same question again and again. How should an investor deal with success in equity investing? Let's say I started a venture and I've sold my venture for, let's say, 200, 300 crores, which is not money which I never thought will come to me. How should a guy who has sold a business be? Because should he, how should he, what should he, because he has made money, he thinks that he can again do something else, or what should be the mindset of this person?
See, it's very difficult to tell a very successful person that you achieve success in that, you don't know money management. Because suddenly he thinks he's become a banker, he's become a portfolio manager, then he has a view on everything, right? He has a view on Tesla, he has a view on whether we should go to Mars, because he's got money. And as a person going to get his money, I cannot even tell him, look, your success there cannot be replicated here. So even you take somebody like a Virat Kohli or somebody, his success is, he earns a lot of advertising revenue and all, does not make him a good fund manager. So you have got to outsource. So immediate answer is put 300 crores in a liquid fund and wait for this euphoria to die, which will take 3 weeks, 3 months, whatever, and then start doing your asset allocation with professional help. Because you may never earn 300 crores again in your life or 200 crores again in your life, and you may need only 10 crores for the rest of your life living well. So 190 crores, you are only a trustee for your children or for charity or for your employees or somebody. Only 10 crores is your own. So whatever you want to fool around with 10 crores, 190 crores, let it be professionally managed. You have no right to mess up the whole thing.
So you're saying that don't deal with that success on a continuous basis. One time you put it away in a safe place or get it administered in a certain way, such that you only live off what you get out of it.
Absolutely.
Maybe 5% of
Absolutely.
that.
Because
only then you will not become a Boris Becker.
Yeah, many American examples. And even in India, film stars are great examples of having earned money then moving into complete poverty. So,
I'll now open the forum for some questions. I'll just give you a minute. I have completed my 10 questions. I have asked him questions without being asked a question. Escape.
Yeah.
Hi, my name is Magesh. And first of all, I should really thank you because post-lunch lunch session always will be sleepy and I think you and I think one round of applause for this gentleman and Shyam for asking wonderful questions.
No, wait. The most important question he did not ask is how much money you need for retirement. If I had given you that, forget sleeping now, you won't sleep in the night also.
No. In fact, maybe that's a part of my question actually. That's part of my question actually. I want to ask you two questions. One is that how much money of my income should be invested in savings? Number one, how much money I should save? What percentage of money I should invest in saving? And the second thing is, how much money I should have? Like you said 1 or 2 years, because I believe that at least I said 90 for myself. Maybe now looking at you, I said 1 or 2 is my target to live. 102 years I'll be living comfortably with good health. How much money I should save for my retirement?
If you had asked me this question in 2019, my answer would have been very different. COVID proved all calculations wrong. We normally used to say husband and wife are holding, so nomination is not necessary. Then we saw couples were dying together, right? So then the not having a nomination was a problem. So if you ask me, it's a big answer. Make sure your documentation is very, very good. Make sure that your Aadhaar and PAN card and all have the same spelling of your name. We are an amazingly bureaucratic, stupid British legacy. British have given up, but we won't. So we are a very, very document-oriented country. So a 2 lakh rupee mutual fund, you will not be able to redeem if the documents is not in place. This is horrible. So first get that ready. Second, there is a universal formula which says 30 times your expenses at your age of 60 is what you should require for retirement. I would add to it an extra maybe 1 crore for medical expenses. You don't know from where, what can happen. Be open to that risk. And be ready for a risk that, parents with 1 kid, if the kid dies before you, somebody should manage your money post your age of 75, 80. Make sure some nephew, niece, friend, son, somebody is there as a backup plan. I mean, heaven forbid, but these things do happen, right? So be ready for that planning. So this would be the answer. 30 times your expenses at 60. So now if you're 50, at least your expenses will double at 60. So that into 30 is what you should require. This is the basic minimum.
So if you're 44.
Yeah, I mean, it's going to double. So if you're 44 times your expenses now.
Yeah.
Any other questions?
Yeah. So there was a question from the YouTube live chat.
Yeah.
So they want about insurance. So they wanted to know how much insurance is enough, or how to calculate that amount.
Insurance also depends on individual to individual. Let's say there is a husband and wife. Wife is a very successful doctor. Husband is a very successful executive. They have no children. Actually, both of them don't need any insurance because they're financially independent. But if there is a person who is supporting his, his children, maybe parents and all that, then accordingly it will go up. But the thumb rule is you should require about 10 times his annual income. But this would be true till he is about 45, 46. But after that, he may not require 10 times because his income will go up and number of dependents, his children could start earning and things like that. So each person has to answer this for himself. But the term insurance which he has should be able to pay off all the loans, and his spouse, I'm assuming this is a man that we are talking about, his wife and children should be able to continue the same standard of living for at least 10 years. By the time they will decide what to do. Sorry. Okay. Depends on whether the family is dependent on you at all. So, like I said, if the husband and wife both are earning independently.
The question would not have gone to YouTube. Let me repeat the question. If you don't have any debt, does it mean that you don't need term insurance?
If you don't have any debt, do you still need term insurance? Yes, you need term insurance because if your earning stops, can your family continue the same standard of living without any capital? If you say capital is also there in place, then you don't need. So yeah, say you're 55 years of age, your children have started earning, your wife is also earning, or you have created enough corpus, at that stage you don't need. But at 32, everybody needs, because the family could be dependent on you. But again, I'm saying a 32-year-old boy whose parents are very rich, who's not going to get married at all, he does not need term insurance, he does not need insurance.
I have a question on how to deal with family pressure, right? Like for example, I'm very comfortable going in a bus. In Bangalore, I go in a normal bus. But my wife says, you should go in a car. Like say you are so-and-so, you should be going in a car. I'm perfectly okay if my family, all of us together want to go in a car, that's okay. But I get this pressure, right? You should go in a car because you are so-and-so.
Sir, you should go in a car. I have shares of Maruti. What will happen to me? So largely, if you pick up a magazine like India Today, you'll have 15 ads, out of which 14 ads are asking you to spend more. So that is the American thing which we have learned. So we will continue to do that. Not just family, society, everybody is putting. The BFSI needs to give money to you to buy a 4 BHK, no, if you are staying in a 3 BHK. Otherwise, how can HDFC make money? So there is pressure on everybody to live beyond their means. Not just your wife. The whole society is moving towards that. So what you're comfortable is not enough. Your family has to be comfortable with that. Yeah.
So use the mic, please.
Okay. For a moment, let us not get into portability of places of work like Singapore, which is what you told about real estate. You don't have to buy house necessarily early because you don't know where you might be working. For a minute, let us just put that away. Today, for a youngster in India, if he knows for sure that he'll be, let us say, working in Bangalore for a foreseeable part of future, and from that perspective, do you think it makes sense for him to purchase a flat or a house in his mid-20s and then pay EMI for 20 years, 25 years? Or use a systematic investment plan and build a corpus till he reaches at about 30, 32 and actually takes that entire house probably straight off purchase or with a 20% loan or a 30% loan, which is basically just to get that section advantage.
Yeah, so first of all, I wouldn't do anything for tax because I do not know how the tax is going to change. So first the tax is out. I won't do a 20-year commitment because I'm going to get a tax benefit. 2 years later, if it's withdrawn, what do I do? So that is out. So I personally have made one formula which says 3 times your CTC should be the cost of the house. You should not have a loan for more than 20 years. All your EMIs put together should not be more than 30% of your take-home salary, and you should do a 40% down payment to buy a house. Not long ago, this was the rule, right? HDFC would not give you more than 50% or 60% of the loan. But now BFSI has got more greedy, they've got more money. So they say we will give you 105% also. As long as you can repay, we don't care what is wrong with you, so you can please borrow. So don't go by the latest rules, so go by the older rules, go to the 1980s, you were not being given so much money. So then you would have followed all these rules.
I have a similar question with respect to buying houses. So you said currently a young kid need not buy a house. But in the past, that is because of the current situation, or because in the past, suppose I want to buy a 20 lakh house, right? I might have only 2 lakhs and I pay for it. Now in 3 years, it has gone double or triple. In the past, it has happened. And it is not the money that I have invested has tripled, but rather the asset has tripled. That means with an investment of 2 lakhs, I have a house which is worth 40 lakhs. Today, the same person, if he has invested in 2 lakhs in a mutual fund or a stock, he would not have got that return. In the past, it has happened, and your recommendation of not buying a house based on the current situation, or if there is a possibility of such a returns, he can still go and invest.
Okay. Largely real estate returns look good simply because people don't put it in an Excel sheet. So even in some very good place like Santa Cruz of Bombay, the returns are much less than what the Sensex would have given. Unfortunately, people don't do that calculation. In real estate, they stay for 20 years, whereas in equity, they want every 2 months, they want to make a change. That is a mistake. So if you have the discipline of saying, I will put money in a good mutual fund for 20 years, that makes sense. Secondly, this does not take into account a person falling ill, not being able to pay, and all those problems. So you discount all those risks when you talk of these returns. Calculate any real estate return, put it in Excel sheet, compare it to, say, some top 10, 20, 5 or 6 mutual funds or even the index, you would have underperformed. However, if it is an emotional requirement that I need a house, then I'm not getting into it. Financially, no, it makes no sense to buy a house, because if financially it made sense for you to buy a house, the BFSI would have said, we will buy the house and give it to you on rent. Since it is more attractive to lend, HDFC is more profitable than any builder. You will need a mic.
Bought a house for 2 lakhs, which is, I mean, the house cost is 20. In 3 or 4 years, it has tripled, and he has held on to it for, say, 20 years, 25 years. I agree to your point. But if there is an opportunity exists, he enters and exits at 3 or 5 years, but still it might make sense, right?
Niranjan Hiranandani made money in real estate. Mr. Deepak Parekh made money in real estate and equity. Uday Kotak made money in debt, capital markets, merchant banking, real estate. So basically you make money with your brain, not with the asset class. So luck, everything has a role.
Sir, I have a question.
Yeah.
This is probably the first generation which is like dealing with Twitter investing basically. People coming out on Twitter and saying, just shouting out their portfolios and shouting out their portfolio returns. How do we manage expectations? And moreover, like you've seen with Hindenburg research coming out with on Adani, how can we be sure of the standards, banking standards, the accounting standards in Indian companies in this era, basically?
Tough question to answer, but if you are in Twitter to do anything other than have fun, you're in the wrong place. As long as you understand that television is entertainment and not education, Twitter is for fun. You may meet some great people on Twitter, all that is true, but you cannot learn from Twitter. You have to still go back to reading books, reading balance sheets before you decide. You cannot learn on Twitter. So the most important thing you can do in Twitter is ignore most of this stuff. Why would somebody come and give free gyan on Twitter? Nobody does it. Everybody is trying to do something on Twitter, whether gather AUM or spread the word or things like that. So if you think you can read my tweets and build your portfolio, bad luck to you. You can't. I can't. So.
Hi, good afternoon, sirs. I have a couple of questions. So one is essentially money. Whenever we talk about money, the emotion associated with it is, fear and, oh, I don't want to make a mistake, so I won't do it. How does one start to have a conversation about addressing that fear, especially with a young audience who is anyway, not equipped with the knowledge or the necessary information to
Depends at what
make a
age
wise
you
decision.
start. Depends at what, a 5-year-old is not worried about money. A 22-year-old is worried about money. If his parents have been fighting about money, if they've seen uncertainty, he will be worried or she will be worried about money, and they'll say, oh, during Harshad Mehta time, my father lost money. It is father's mistake, but they'll blame Harshad Mehta for it, right? So we can't help it. So if somebody has come with that baggage, what can you do? So slowly this fear has to be removed. You have to show track record. And the problem is, for 5 years, he or she does an SIP, then the market falls. Economic Times will carry a brilliant headline saying, PPF gave you better return than equity funds. That time the kid's father will say, I told you, we don't have to go to equity. Leave it to the Marwadis and Gujaratis. We are South Indian. We should not put money in equity. So the kid has to handle all this pressure. How that kid handles is a lot of luck and some skill. And then reinforcing that, boss, you go and read the classics. Don't read Twitter and don't read Economic Times and come to wrong conclusions. That's all you can do. Actually, if you are an advisor, stopping your clients from reading all this shit is your biggest goal. It's very difficult. Because they'll come and say, see, Naren said we should put money in BAF. Arey, Naren doesn't know my portfolio. Why is he saying that? But I can't ask Naren not to say that. Right? So clients will read everything and clients say, Naren told me, so put 5 lakhs in BAF. So put, you can't help it.
Thank you.
Sorry, Naren, if you're hearing this.
Good afternoon, sir.
I can't see you.
Yeah. So my question is about the behavioral part in investing or personal finance. So what are some of the points or some tips from you that will help us to tame our behavior, especially in extremities of greed and fear?
First of all, understand, whatever you read about behavioral finance, you will still succumb to behavioral finance. So understand that. So you keep reading and you keep hoping to improve, having discussions, reading more. Today, everybody talks about behavioral finance and continues to do that, right? So you bought, how many people can you stop from saying, I know somebody who came and told me that I'm going to buy Paytm at 500 because Paytm will go back to 3,000. When will it go back to 3,000? In 1 year. So 6 times in 1 year. So which means he thinks the index will go from 60,000 to 3,60,000 in 1 year. Such people are there in the market who believe that they've got anchoring. So, okay, Adani was here, so it has fallen. Now it will go back there. There is no such guarantee in life, right? So you go in, you get hurt. If you ask me, the best thing to do for everybody here is to make a very important 200 rupee investment. Buy a nice notebook and keep writing whatever you feel. Okay? Write down all your feelings. 6 months later, you will know what an idiot you were. Then you will go to index funds. Or you will have a classic book on humor, saying, oh God, how could I think like this? Or you could be such a good fund manager that Shyam will give you a job. The 200 rupee book has an infinite ROI.
So thanks to Shyam, I saved 200 rupees.
Give him the book.
So write it in your own hand. Don't write it in Word, because when you write it in Word, you will go back and delete. So write by your own hand, and if you like fountain pen, buy a fountain pen. There's a fountain pen fan here, therefore I'm saying. But buy a pen, write it by hand, and after 6 months you will see. And if you think there is an expert who comes on TV, write down everything that he says. After 6 months you will know you know more than him.
Many times what you write in this book you would not have followed. That will make you hit yourself on the head. You know, sometimes you write a portfolio. I have this habit of writing portfolios. When I'm bored, some new portfolio I will write and then leave it. And then these books accumulate. I have 5, 6 of them. So later there will be a date also against what I write. When you go back and just look at that book, you will see, oh, I have written all these books. I have written a portfolio which has got all these shares, Astral, Page, everything written at 400, 500 rupees. Then later you realize that you have not followed what you have written. You followed something else the next morning. So it's very important that you keep looking at what you write also. So you may write something and just not look at it again. Happens.
So please maintain that investment diary. It's very under, nobody says maintain an investment diary, but maintaining an investment diary is one of the best things that you can do. Keep reading what you have written, what you think, oh, Adani is finished, now everything will happen. 6 months later, you look, if the Adani shares are up, you will look wrong. Like for example, March 2020, I went and bought Indigo at 800 rupees, saying, Kabhi to khatam hoga na problem, world is not going to end. So Indigo went up. Then you look like an idiot because Buffett says no airline ever made money. So you will keep doing some of these things, writing down and checking what you're doing. And the best person to share this with is your son, saying this is how I think. So son will also know what an idiot you are. So then that ego will go away. Yeah. Sir, only one question per person. It's okay. No, ask. This is joking. There is no quota. I got a 9:30 flight. He's got an earlier flight.
So in many of the presentations, that corporate governance always hits my mind. The discussion about corporate governance, right? So is it possible to do a forensic audit only by looking at the balance sheet or only when you discuss with the management?
The chances of doing it by not meeting the management is higher than by meeting the management. When you meet the management, you will be convinced that the management is good, because they will intimidate you into believing it is good. I met a judge of Delhi Supreme Court, and he said, after Nani Palkiwala argues, for 3 days I don't come to a decision. I wait for the Palkiwala effect to go away. So a promoter will tell you why his company is the best. You have to wait for 3 days for that to go away before you decide. But I don't think I'm worried too much about corporate governance. I'm only saying, does he leave enough on the table for me? Because you cannot do a corporate governance study and all that is bullshit. To me, the ESG fund in India should be called ESGJ, where J stands for a joke. You don't know which company is good, which company is bad. History tells you these companies are good. When they earn 100 rupees, they pay you 30 rupees. So it's a good company. Don't get into how they earned, what they did. Every company you can find bad things and good things.
Friends, last question. After that, you can have some offline questions if you wanted to.
Yeah.
Last one last one.
Nobody.
Kalpen, here, yes.
Big boss.
Right in front. Come to the front.
No, I attend sessions and speak a lot, but this is one of the best conversations that I have experienced in so many years from both of you. And Subra, I am a fan of yours, so it's a biased question. How have you learned, apart from experiences, to become, and I know you will say that you are still not the best investor, but you keep on learning and minimizing mistakes and errors. So what is your approach to keep learning and becoming less poorer?
So let me put it this way. The worst thing about Ravan, he did not have satsang. Okay? He had a lovely wife in Mandodari. He had very strong brother in Kumbhakarna. He had a very educated brother in Vibhishana. He had a Indrajit, great son. He had Soneki Lanka. He had everything. What he missed was satsang. To be a good investor, you need satsang. You need friends who will say, look, idiot, how much you have lost. What a mistake. You are overly biased towards equity. You need friends who will tell you that. It can only be friends. It can't be the spouse. It can't be the children. It has to be friends who are doing well, doing badly, doesn't matter, with whom you can discuss. And even today, I don't know how people can just go to a broking house and do online. I can't. I still need my broker who will laugh at me and say, are you mad?
Thank you everyone for staying back and participating in the Fireside chat. We'll also have tea and coffee served around 4, and everybody from ITHOUGHT will also be available to speak to you guys and network. Also, just a reminder on the feedback forms that you all would have received on your phone number and email ID. Thank you. Thank you so much for joining us today.